All right then, welcome everyone to today's class, which is on deducting taxes, interest, and charitable contributions. We're going to be spending pretty much an hour on each of these subjects. And let's begin by taking a look at this little section of Schedule A right here. In this morning's class, we covered medical and dental expenses, and in the afternoon class today, we're going to be looking at taxes you paid, interest you paid, and gifts to charity. So this big middle section of Schedule A is where we are going to be spending our time today. I'm going to start with deductible taxes. And you can claim certain types of taxes as a deduction on Schedule A. Some kinds of taxes are eligible for special credits. So depending on the type of tax, you may or may not be able to deduct it on Schedule A, and we're going to look at some of the rules. And you will notice that when we look at Schedule A, there is a line for state and local income taxes, and then inside that you have a box A or a box B, depending on its income tax or general sales tax. There's a line for real estate taxes. Many people refer to real estate taxes as property taxes, but the IRS separates real estate taxes from another category called personal property taxes. So over the years, I've just learned to call real estate taxes, even though clients tend to think of them as property taxes on their house. And then finally, one line for every other kind of tax that's left over that can still be deducted on Schedule A. And that's line 8. Now, to enter a tax of any kind on Schedule A, it has to be deductible. And to be deductible, it must meet two tests. Firstly, the tax must have been imposed upon you or on property that is owned by you, and the tax must be paid by you during the year. So what does it mean to be imposed on you? Well, the tax must be imposed on your income or on property that you own. Taxes that you pay on property you do not own generally are not deductible. Paid by you. Assuming you are a cash basis taxpayer, and nearly everybody is, you must pay the tax during the year for which you are filing. And here is an example where we have a tax that was imposed but not paid. If the tax is imposed on you in 2014, but you do not pay it until January of 2015, you cannot claim a deduction for it on your 2014 return. You will be able to claim a deduction for it on your 2015 return. And this is actually something I have to contend with quite often. Clients will come into my office and they will deliver to me their property tax statement from their house. So their real estate tax statement showing the assessed value of their home and the taxes imposed on that assessed value. But that statement does not tell me that they physically paid the tax. It only tells me that they owe the tax. And very often, they haven't paid the tax, at least in full. Many people get these property tax statements, and the statement might show a whole year's worth of taxes, but those taxes can be paid in installments, or maybe they're just late on the payment. So not only is it necessary to determine that they do owe the tax, it's also necessary to establish the date that the tax was paid. A lot of clients that pay these taxes by check rather than through escrow on their bank accounts I can't quite remember the dates that they made payments or the amount that they paid when they made payment. If I'm lucky, they've indicated on the property tax statement the date that they paid and the amount that they paid and the check number they paid it with, but often they don't have that information. I have clients that never, ever bring me their property tax information. And so what I do in those situations is I end up calling the county where their property is located and getting the county to tell me the dates and amounts that tax payments were made. I've gotten quite good with having that number handy and dialing it several times every tax season. Taxes have to be imposed upon you or on property that you own, and they must have been paid by you during the year to be deductible. We're going to look now at income taxes and the rules for deducting income taxes. Income taxes are deducted on Schedule A, line 5A, and you can deduct the following income taxes that you paid during the year, including state and local income taxes that were withheld from your pay during the year. State and local estimated tax payments are deductible if you believe you needed to make those payments and you actually made them during the year. And a refund of state tax that you choose to have credited to next year's tax is also allowed as a deduction. State or local government balance due income tax payments that you paid during the year. So, for example, your 2013 return was due in 2014, And your tax payment for your 2013 state return, the amount that you owe with it, is typically due by the due date of that return, which is usually April 15th. And so you file your state return and you make the payment for your 2013 balance due in 2014. And if you make that payment, it's deductible on the 2014 return. Mandatory contributions to state benefit funds that are withheld from your wages and provide protection against the loss of wages are also deductible, and certain states require employees to make contributions to these state funds that provide disability or unemployment insurance benefits. There's not a large number of states that have these funds, but the ones that do are listed here. You can find these in Pub 17. The state of Alaska, California, New Jersey, New York, Pennsylvania, Rhode Island, and Washington State all have compensation or worker benefit funds that the tax payments into these funds are withheld on their W-2s, and these amounts can be deducted on Schedule A as a tax paid. Now let's look a little bit at estimated tax payments and when they are and are not deductible. And in example number 1, we have an estimated tax payment that is not deductible. You made a $3,000 estimated tax payment to your state in January of 2015 for your 2014 state tax return, even though you knew that this would result in an overpayment of tax for your state. When you filed your state return in April of 2015, you received a refund of $4,000. You may not claim a deduction for the estimated tax payment of $3,000 on your federal 2014 return, and you're not going to be able to claim it on your 2015 return either. Example number 2, overpayment amount applied to estimated tax payments. You elected to apply $500 of refund from your 2014 state tax return towards the 2015 estimated taxes. You should include this $500 payment as an itemized deduction on Schedule A a year from now when you file the 2015 return. Example number 3, the 2013 state balance due is paid in 2014. You filed your 2013 state return in April of 2014, and you had a balance due of $500, and you paid that balance due before the end of 2014. You can claim a Schedule A deduction for that $500 of tax that you paid when you file that 2014 return. There's some notes here on refunds of income taxes. You should not reduce the amount of your income tax deduction by refunds that you received during the year. If you received a refund of taxes paid for an earlier year and you previously received a tax benefit from deducting that tax for that earlier year, you must include the refund in your income to the extent that you had a tax benefit for that earlier year. And here are some examples of what I mean by that. And really what the IRS is saying is you don't take the fact that you had $5,000 of state income tax withheld from your pay this year, but you have a $1,000 refund from last year, so we're going to net those out and take a $4,000 deduction instead. That's not what they want you to do. Here is an example where a state refund, though, is not taxable. You did not itemize your deductions in 2013, and you then received a state income tax refund of $400 for your 2013 state return, and you received that $400 refund in 2014. Because you did not receive a tax benefit from deducting the taxes from your federal income, you do not need to report that 2013 state refund as income on your 2014 return. Now, one of the things I see tax preparers do, and it's really one of those things that irritates me, is they'll see a refund card coming from the state, and when the state issues a refund, it often will issue a Form 1099-G that shows the amount of that refund. And a 1099-G typically is issued by a state only when the state believes it could be a taxable refund. But it can issue that refund card even when the refund is not taxable. And so when a tax preparer just assumes that because there's a 1099-G that refund is fully taxable, they're really doing a disservice to the client because frequently it's not taxable. Example number 2, the state refund, though, is fully taxable. You did itemize in 2013, and you received a full tax benefit from claiming your 2013 state income taxes as an itemized deduction on your federal return. You must include your $400 state refund received during 2014 as income on line 10 of the 2014 return. And here in example number 3, we have a state refund that is partially taxable. You did itemize in 2013 and received only a partial benefit from claiming your state income taxes as an itemized deduction. You must determine what portion of the state income taxes paid actually benefited you when you claimed them as an itemized deduction on your 2013 Schedule A. You should include as income only the amount of taxes deducted that actually benefited you. And I have an example here, and this is a very elementary example. Determining whether or not there was a tax benefit from a state refund can be frequently more complex than this illustration. But this illustration is done at a very elementary level to an extent that the IRS actually creates a worksheet for it. And if, based on this worksheet, you determine that the refund is partially taxable or fully taxable, you can go with that number. However, it could be that the worksheet is not allowing for all factors. But still, because the IRS provides the worksheet, I'm going to show you an illustration of how it works. And here we go, figuring the taxable part of your refund. In April of 2014, you filed your Married Filing Joint 2013 return. Your itemized deductions claimed on that Schedule A for that year were charity of $1,000, state income tax of $2,000, mortgage interest of $8,000, and property taxes of $14,000. When you add all of those deductions up, you get $12,400. The thing is that the standard deduction for 2013 was only $12,200. So really, if you'd claimed the standard deduction, the amount of money you would have saved by itemizing in that year is tiny. You benefited by itemizing to the tune of a $200 deduction and no more. So if you receive a refund from the state of $1,000, you could have just as well filed for that year and never deducted state tax at all and just gone with the standard deduction. So what that's saying is that most of the state refund is not taxable. And in fact, how you determine how much is taxable is to take the lesser of $200 or $1,000 that was actually received. And in this case, the $200 is the taxable part of that $1,000 refund. And here is the IRS's worksheet from the instructions for Form 1040, line 10. It says, start with the state refund received, enter the itemized deductions for the earlier year, compare those to the standard deduction for the earlier year, subtract the standard deduction from the itemized deductions, and the difference is the taxable refund. But it could be the case that none of the refund is taxable. For example, if we look at a 1040 return and the person did itemize, and they get their itemized deductions at a point where their taxable income would be zero even if they hadn't claimed all of their itemized deductions, then you have a situation where a refund may not be fully taxable there too. So let's think of a really good example where this could happen. Let's suppose you've got a married couple with $30,000 of income, and they claim $15,000 of itemized deductions, plus they've got 3 kids. Plus they paid a child and appendant care expense. Whether they itemize or not, their tax is going to be zero. The reason it would be zero is because they're going to be claiming the child and appendant care credit. They're going to be claiming exemption deductions. They're probably going to be able to claim an earned income credit. By the time they do all of those actions, their tax liability is just going to be 0, 0, 0, 0. So itemizing probably doesn't save them any money at all. And so if you're in a situation where you're not sure whether or not a person benefited from a refund, the thing to do is to look at the prior year return, take off the state taxes that were itemized, and refigure the tax without the state tax being deducted. And if the net tax is the same, then the state refund that they received would not be taxable. Let's look now at the deduction for state sales tax. This one's a little bit more work to figure out, because when you're deducting state income taxes, you simply look at how much tax you paid in the form of estimated tax or was withheld on your W-2 or on your 1099-R. Whatever amount is showing as withholding, that's the amount that you get to deduct. In addition to that, any amount that you paid as estimated tax, you get to deduct. But for sales tax, it can be a little bit more complicated. So we're going to spend some time talking about the deduction for state sales tax paid. Now, this particular deduction was originally brought in the Bush era and was intended to expire at the end of 2009. However, it keeps getting extended. It's one of those ones that just won't die. It keeps coming back. And my expectation is it'll continue to be brought back every year, including through 2014. But as we sit here right now in 2015, this deduction for state sales tax has expired. Unless we see legislation sometime during 2015 or the early hours of 2016, we will not have this deduction for 2015 returns, but my guess is that it will get extended. Now, the state sales tax deduction is offered in place of the state income tax deduction. So you can claim either the state income tax deduction or the sales tax deduction, but not both. And if you elect to deduct income taxes, you're going to check box A on line 5 of Schedule A and then enter the amount of state and local income taxes that you paid. And if you elect to deduct sales taxes, you're going to check box B and you will claim a deduction for sales taxes that you paid using one of the following 2 methods. Under Method 1, you use the actual amount for the state and local sales taxes that you paid. And to calculate the actual sales tax that you paid for a year, you would need to save all of your receipts and tally up all of the sales tax that you paid during the year. You can imagine that there's not a whole lot of people out there who do it that way. And to save that trouble, the IRS has method number 2 available. And under method number 2, you will complete the state and local general sales tax deduction worksheet, which is shown below. And you will use the optional sales tax tables when you're filling the worksheet out. And you will see that the worksheet says enter your state general sales tax from the 2014 optional tables. So I'm going to show you those in just a minute. And then it asks if you lived in one of the states listed here. And if the answer is yes, you're going to use a general sales tax optional local table. And if the answer is no, you're going to do another computation. Did your locality impose a local general sales tax? If it did, you're going to carry through with some computations on this form. And then it asks, did you pay any sales tax on some high-ticket items like a new car or a boat or an airplane, something that would be beyond normal and not normally spent, and possibly was even purchased with borrowed money? You get an extra deduction for the sales tax you paid on that, and space is provided to figure that computation in here as well. So I'm going to show you these tables that I'm referring to, because line number 1 says go to the tables and figure the amount from the tables based on the number of exemptions that are being claimed on your return. You can see that there's a separate table for each state. Here we have Alabama, then Arizona, here's Connecticut, here's Kansas, Kentucky, and so on. And what you do is you look for your income, and then you follow the table across to the state that you live in. And then you ask how many exemptions are you claiming as a resident of that state. And in this particular illustration, we have Mike, who is a single filer claiming 1 exemption for himself. And he is able to claim $635 of sales tax deduction based on income of $40,000 to $50,000. But there's actually more to figuring the amount of sales tax deduction an individual can claim than just looking at this worksheet. So we're actually going to go do an illustration for Mike, and I'm going to show you the next page of this table as well, because Mike, in our illustration that I'm about to show you, actually resides in 2 states. He resides in California for part of the year, and he resides in Washington State for the second part of the year. And so we have to actually look up 2 numbers on this table. The first number that I just showed you was the sales tax allocation for California, and this second number we're looking at Washington State. So Washington State says start with $611, and California says start with $635. So now that we've got those 2 figures, or at least understand where they come from, let's do an illustration involving this character named Mike. So Mike is a single filer with income totaling $40,000, and during the year he resided in the following states. He was a resident of Orange County, California from the 1st of January through April 30th of 2014, and then he moved to Clark County, Washington, where he lived for the remainder of the year, which is basically May through December. In March, before he left California, Mike bought a new boat. He paid $2,720 of sales tax on the boat at the time that he purchased it. And now we're going to calculate the deduction for sales taxes paid that Mike is allowed to claim on his return. Now, based on his income, the amount for a single exemption on each state is as follows. For California, we found $635 on the table. And for Washington, we found $611 on the table. But we're not quite done, because understandably he can't take a full year deduction for each state when he was only in each state part of the year. So naturally we need to do a ratio. And to do that ratio for California, we're going to add up the number of days that he lived in California. And he lived there for January, February, March, April, or a total of 120 days out of 365 days for the year. If you divide 365 into 120, you get 0.3288, or 32.88% of his year was spent in California. We're going to multiply 32.88% by the amount shown in the table for California of $635, and when we do that, we get $208.79. We repeat this same procedure for Washington State, but of course he was in Washington longer, and so it turns out that 67.12% of his year was spent in Washington State. So we're going to take 0.6712, multiply that by $611 for Washington State, and when we do that we get $410.10. We now take California of $208.79. We add that to Washington at $410.10, and we get $618.89. So we did all of that to figure out what number to enter on line 1 of his worksheet, or in this case, we're completing 2 line 1s on 2 separate worksheets. And because he was in 2 states, we're going to do 2 separate worksheets all the way through start to finish. On the line 2 of his California worksheet, we're going to check no and enter 0 because he is not in one of the localities that has a separate table. Washington, same thing, he's not in a locality that has a separate table. And then we go on to the California worksheet, line number 3, and we check yes, there is a local sales tax. And if you research the local sales tax for Orange County, we come up with 0.5%. And if you research the local sales tax for Clark County in Washington State, you come up with 1.9%. The next step is to look up the rate of tax for each state. And we have a rate of tax for Orange County, or for California rather, of 7.5%, and a rate of tax for Washington of 6.5%. The next step is rather interesting. I think it's interesting anyway. The instructions for the worksheet say take the local rate and divide that by the state rate. So the local rate for Orange County of 0.5% is divided by the state rate of 7.5%. And when you do that, you get 0.0667. For Washington, you take the county rate of 1.9%, divide that by the state rate of 6.5%, and when you do that, you get 0.2923. The next step is to take these percentages for each local rate and multiply those by the total amount of sales tax deduction for the state. So if you remember up here, in this step, we came up with $208.79 for the time spent in California and $410 for the time spent in Washington. We're going to take those 2 numbers and multiply those by the ratios we got for the local rate. So for California, it's 0.0667 times $208.79. We get $13.92. And for Washington, we're going to take 0.2923, multiply that by $410, and when we do that, we get $119.87. And then on line 7 of the worksheet, we're going to enter $2,720. That was the amount of sales tax paid on that boat. And now the final step is to take all these numbers and add them up. We're going to take this $618.89 from line 1. We're going to take the $13.92 for the local rate on California, the $119.87 states for the local rate on Clark County, and then we're going to add in the $2,720 paid on the boat. And when we do that, the total amount we get for all those figures added up becomes our deduction. And the total deduction for the year is going to be calculated as follows. Now, what I've done for you is I've taken these taxes and these manual computations that I did that gave us a total deduction from those 2 worksheets. And the total amount that we're going to enter on Schedule A is going to be $29.42 plus $529.97. We're going to take those 2 numbers and add them together, and that's the deduction. But when we move over to the next page, I'm going to show you an easier way to get to where I got. And that is to go to the IRS's website and actually use their sales tax deduction calculator. They do have one on their website. And if you go in and use that calculator, the starting point is to tell the calculator what the income of the filer is, the number of exemptions that they have, and the zip code that they lived in each state. And then it actually puts all these figures in here for you. So here we have the California rate, the Orange County rate, the Washington rate, the Clark County rate. It does the percentages here based on the number of days you say you lived in each state. It figures the state tax amount, it figures the local tax amount, and adds them together. So here is the state rate for California, here is the Orange County rate, here is the total. Here is the state rate for Washington, the local rate for Clark County, the total, and then the final step is to add in that tax paid on the boat, $27.20, and we add those figures together and we get $473 as a deduction. So actually, illustration number 1 is a fairly complex illustration because it involves a multi-state tax situation. But the next illustration I'm looking at is going to be cleaner and simpler. This particular couple has lived in the same state the entire year. This is as simple as it's going to get. Sam and Jane are a married couple with 2 dependent children, and they were residents of Clark County, Washington for all of 2014. Their income from line 38 of Form 1040 plus non-taxable income not reported on 1040 was $80,000 for the year. They paid $40,000 for a new SUV during the year. Figure the amount to enter on their state and local general sales tax deduction worksheet as follows. On line 1, we're going to get $1,087, and that comes from the tables again. So let's go to the tables, and this time we've got a household income of between $80,000 and $90,000 and an exemption count for Washington State of 4. And if I zoom in on this so you can see it a little better, you will see that 4 exemptions for Washington State comes out at $1,087. So we're going to take that $1,087, and it's going to be the starting point for our computation. Again, line 2 references whether or not they're going to qualify to use the optional tables, and the answer is no, they don't qualify to use the optional tables. Instead, they're going to use the actual rate for their county, which is 1.9%. We're going to take 6.5% from the table and divide that into 1.9% for the Clark County rate. When we do that, we get 0.2923. We're going to check yes on box 6 and then multiply $1,087 by 29.23%. When we do that, we get $318. Next, we're going to figure the amount of tax or determine the amount of tax that they paid when they bought that new SUV. And the combined rate of local and state sales tax they paid on that SUV was 8.4%, giving them a total sales tax paid on that new SUV of $3,360. So we're going to take $3,363, add that to $318, and add that to $1,087, and we've got the deduction that they're allowed to claim, which is $4,765. So here is the sales tax deduction calculator that the IRS provided on its website. Residents of Clark County, Washington, state rate 6.5%, local rate 1.9%. The entire year was spent in that locality. The state rate is $1,087, the local rate $317.74, and the total tax for the sales tax part or the worksheet part of those computations is the $1,404. And then we're going to add in the sales tax paid on the SUV to get their total deduction of $4,765. And that $4,765 will carry to line 5 of Schedule A, and we're going to check box 5B to indicate that the general sales tax deduction is being claimed. Now here is the completed worksheet for these particular filers. You can see line 1, we've entered that $1,087. Line 3, we've entered 1.9% as the Clark County rate. Line 4, we enter the state rate. Line 5, we do a divisor of the Clark County rate by the state rate, and when we do that, we get 29.23%. We do the multiplication of 1,087 by 0.2923, we get 318. We add in the tax paid on the SUV, and whammo, we've got the total state sales tax deduction allowed for the year. And moving through these worksheets, I wanted to get to the next page where you can see we have optional sales tax tables. If you check yes to question B rather than no, then instead of looking up the local rate and doing the computation, you would actually come to these tables. If your locality is listed on the tables, you will simply find your locality. For example, you're in Arkansas. Regardless of the locality you're in, you're going to go to Table B, and here's local table B, and then you would just figure the amount of local tax deduction you're allowed based on the figure pulled off of local table B. Actual expenses versus the optional sales tax tables. You can choose to deduct the amount of sales tax you actually paid for the year, or you can choose the optional method for calculating sales tax. As you can imagine, the actual method is going to be messy, tracking all of the receipts. You'd probably have to do an Excel spreadsheet to add it all up. Your receipts probably fade. You probably lose them. Sounds like a nightmare to me. So the optional sales tax tables are obviously the way most people are working. The main difference between actual and optional beyond the work level is if you actually are pretty good at spending and you spend everything you make, you're not a hoarder, you're not a saver, just spend, 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 the actual expenses might give you a bigger deduction. Whereas using the optional sales tax table is controlling the amount that you are allowed to deduct regardless of how much you actually spent. So in summary, the tables give taxpayers a sales tax deduction amount as an alternative to saving their receipts throughout the year and tabulating the amount of tax actually paid. Taxpayers use their income level and the number of exemptions to find the sales tax amount for their state. The table instructions explain how to add an amount for local and sales taxes if appropriate. Now, taxpayers may also add to the table any sales tax that is paid on a motor vehicle, but only up to the amount of tax paid at the general sales tax rate, and also tax paid on an aircraft, boat, home, including a mobile or prefabricated home, or home building materials, if the tax rate is the same as the general sales tax rate. Now, there are certain states that have no income tax. And if you live in one of these states, really the likelihood is that the sales tax is the only deduction that you have that you could even consider claiming. And the states that have no income tax and have only a sales tax include Alaska, Florida, Nevada, South Dakota, Texas, Washington, and Wyoming. So taxpayers living in states, though, that have both a sales tax and an income tax may find they are able to claim a larger deduction in years where they purchase a big-ticket item like a new car. And in years where they haven't purchased those big-ticket items, perhaps they're better off claiming the income tax deduction. That concludes the look at the sales tax deduction. We're now going to move on to the next line of the Schedule A, and that takes us to line 6, where we figure the deduction for real estate taxes paid. And you can claim a deduction for taxes imposed on real property that you own, provided the taxes are assessed based on the value of your property, that they are levied for public welfare, the tax is imposed upon property you own, and the tax must have been paid by you. Taxes assessed to improve the value of your property are not deductible. For example, there is an assessment that improves the value of your property. You are levied $2,500 to pay for sewer connections at your home. Because this levy is to improve the home, no deduction will be allowed. Proration of taxes on the purchase of property. Because you can only claim a deduction for taxes assessed on property for the period of time you own it, you should review settlement statements for tax prorations between the buyer and seller when you buy or sell a home. And here's what I mean by tax proration and when it's required. You bought a new home in October of 2014, and then in November of 2014 you receive your annual property tax assessment showing $2,000 as your July 2014 through June 2015 property tax levy. You will be the owner of your home for 9 out of the 12 months in this assessment period. So you purchased the home in October of 14, but the tax statement you've received includes 3 months for before you owned that home. Well, you can't claim a deduction for taxes that are not imposed on you or on property that you owned, and any portion of the tax assessed for a period where you didn't own the home was not assessed on you or on property you owned at the time, and therefore that part of the year would not be deductible to you. Now, for the portion of the assessment period that you were not the owner of the home, that is July, August, and September, you're going to need to prorate your deduction to include only the portion of the tax that was actually assessed while you were the owner of the property. Assuming that the tax was assessed in full before the end of the year, you can claim a deduction for 9/12 of the $2,000 assessment, and that means that the amount that you would be allowed to deduct is $1,500. Now let's look at an illustration of how all of this would come together. And this is where we're looking at the seller's part of property taxes. In November of 2013, little Jimmy paid $2,592 of property taxes that were due on his home for an assessment period of July 1, 2013 through June 30, 2014. He deducted the taxes on his 2013 Schedule A. And then in April of 2014, Bimbo and Betty Boop purchased the home from little Jimmy. So in November of 2013, Jimmy pays the tax bill on his home. And then a few months later in April, he sells the home to Bimbo and Betty Boop. So what's just happened is he's paid a tax bill in November for an entire fiscal year that runs July 1, 2013 through June 30, 2014, and now he has sold the home before the end of that assessment period. So that means he's claimed a deduction in 2013 for an expense that ultimately he can't claim the full amount. So he's going to get an actual refund of that expense coming back to him. So since the home was sold partway through the assessment period of July 1, 2013 through June 30, 2014, the settlement statement for the sale of this home shows an allocation of $454.49 as an adjustment item to the seller on line 107 of the settlement statement. And how do we get that number? Well, we take $2,592 for an entire year's assessment of property taxes and divide that by 365 days. And then we multiply that by the number of days that fall after Jimmy sold the home, which is 64 days. When we do that, we get $454.49. Well, that $454 represents the amount of tax assessed for the 64 days in the assessment period that fall after Jimmy sold his home. And since little Jimmy claimed a deduction for those taxes on his 2013 return, that $454 that he sees on his settlement statement is actually going to be taxable income to him. So here we see line 07, county taxes, that shows the assessment period for which he is no longer owner of the home. April 28 through July 1st, 2014, the tax amount allocable to that period of time, $454, that is not tax Jimmy owes, and so the deduction he claimed for paying it in the earlier year was too large. He's now getting a refund of that tax amount back. He does not go back and amend the 13 return. He leaves it as it was. But what he does do is he's going to need to report these refund of property taxes as income on his 2014 return. And he would enter that on line 10 of his 2014 return. All right, let's take a look now at illustration number 2, because the first illustration, we have Jimmy claiming a deduction in 2013 for an entire fiscal year because he made the payment for the entire fiscal year in 2013. But not everyone is going to pay their property tax bill all at once. Some people pay their property taxes in installments. So if we change the situation and say that Jimmy paid in installments, then how we treat those payments is going to change, obviously. So we're going to assume all of the same facts as in illustration 1, except that when Jimmy received his 2013 through 14 property tax assessment, he decided he was going to pay it in 3 equal installments as follows. He made one payment in November of 2013 for $864. He made a second payment of $864 in February of 2014. And then he made a third and final payment in April of 2014. Now, because little Jimmy paid only 1/3 of his taxes in 2013, his deduction that he claimed on his 2013 Schedule A would have been limited to that 1/3 amount, or $864. And since little Jimmy paid the remaining amount of $864 plus $864 for February and April in 2013, that remaining $1,728 will be deductible to him in 2014, but not in full. He still has to factor for the portion of that tax that is going to get credited to him at close. And the amount that's going to get credited to him at close when he sells to Betty Boop is $454. So he's going to take the amount of tax he paid in 2014, and from that he's going to subtract the $454 amount that is credited to him at close. And so the difference of $1,274 is going to be the amount he can deduct on his 2014 Schedule A. So those were 2 different scenarios for how Jimmy would claim these prorated property taxes. But let's look now at the buyer, because the buyer is Betty Boop. And that $454 that's credited to little Jimmy, that money has to come from somewhere, and it comes from Betty Boop. When she purchases the house and goes to close, she's going to have to bring that $454 to the table, and that money will then transfer from her to little Jimmy. And since she has now just paid $454 for real estate taxes for an assessed period of time where she is the owner of the home, which is April 28th through June 30th of 2014, that $454 is going to be deductible by Betty. So let's just suppose she's living in the house, she made that proration amount at close, and a few months later, it's November 2014, and she gets the annual property tax statement in the mail, and that property tax statement says that the assessment for the 2014 through 15 year is $2,650, and she pays it in full on November 30th of the year. Her deduction that she will be allowed to claim on Schedule A is going to be the full $26.50 that she paid in November plus the amount that she paid at close. So she's going to pull $454 from the settlement statement. She's going to add that to the $26.50 that she mailed in November, and that's going to leave her with a total deduction that she can claim on Schedule A in the amount of $3,104. So let's look at some real estate items or real estate related items that you cannot deduct next. Payments for the following items generally are not deductible as real estate taxes, and these include taxes for local benefits, itemized charges for services such as trash and garbage pickup fees, transfer taxes or stamp fees, rent increases due to higher real estate taxes, homeowners association charges, taxes for local benefits, and taxes assessed for local benefits and improvements that improve the value of your property are not deductible. Examples of these types of improvement assessments can include street paving or improvements, sidewalks, water mains, sewer lines, public parking facilities, and similar improvements. You should increase the basis of your property by the amount of these types of assessments. Local benefit taxes are deductible only if they are for maintenance, repair, or interest charges related to those benefits. Now, if only a part of the taxes is for maintenance, repairs, or interest, you must be able to show the part that you can deduct and be able to separate that from the amount that is the improvement that is non-deductible. So we're done with line 6. Now let's take a look at line 7 of Schedule A, which is where a deduction for personal property taxes is allowed. Most states impose personal property tax on cars and planes and motorhomes, big ticket items like that. Most states also impose personal property tax on businesses, but if you are paying personal property tax on assets owned by your business, those would be deducted on your business return. So we're looking at personal property tax assessed on personal property that you use for personal purposes. Examples, again, include things like a boat, RV, or airplane. And if you pay a personal property tax assessment on that type of property, it can be deducted on Schedule A, and you would enter it on line 7. Now, to be deductible, the tax must be charged on your personal property based only on the value of the property and charged on a yearly basis, even if it is collected more or less than once per year. Fees you pay for licensing or registering your vehicle are not based on the value of the vehicle and are not deductible. Foreign income taxes, Schedule A, line 8. You can claim the itemized deduction, or you can claim an itemized deduction for foreign income taxes paid on income that is not exempt from U.S. taxes because you claimed the foreign earned income exclusion. You may be able to claim a foreign tax credit as well, but you cannot claim a foreign tax credit and an itemized deduction for the same foreign tax paid because remember, no double deductions. Now, even if you did not work overseas, you may have paid foreign income taxes if you owned foreign securities through direct stock ownership or through a mutual fund. You may also have paid foreign taxes if you have a rental property or other types of income-producing property that are outside of this country. So if you're paying foreign income taxes, the taxes you pay to that foreign country can be claimed as a credit on Form 1116, or you can claim them as an itemized deduction, but not both. So let's look at this summary table of where to deduct taxes paid. Although you can deduct certain taxes that you paid on Schedule A, you may need to deduct a tax you paid on another form or schedule instead. In deciding where to deduct a tax, you should consider whether the tax was a personal or business expense that you paid, and the following chart summarizes how to deduct most of the taxes that you might have paid. State and local income taxes, these are deducted on Schedule A, line 5A, and sales taxes are deducted on Schedule A, line 5B. Foreign income taxes are deducted either on Schedule A, line 8 or on Form 1116. Real estate taxes are deducted on Schedule A, line 6. Personal property taxes are deducted on Schedule A, line 7. Real estate and personal property taxes that are assessed on your rental property are deducted on Schedule E, and real estate and personal property taxes assessed on your business are deducted on Schedule C. Self-employment tax, the deductible part of it, is deductible on Form 1040, line 27 as an adjustment to income. And all other taxes that are deductible that we haven't covered anywhere else, those are claimed on Schedule A, line 8. But let's take a look at some types of apparent taxes that you're not allowed to deduct. And these include fees and charges. For example, fees you pay for a driver's license or registration are not deductible. Transfer taxes. You cannot deduct taxes imposed on the transfer or sale of property such as your home or car. Federal income taxes, Social Security taxes, or Medicare taxes. You cannot deduct federal income tax, Social Security tax, or Medicare tax. The exception to this is that you are allowed to deduct 1/2 of your self-employment taxes, an above-the-line deduction on Form 1040, line 27. But you are never allowed to claim that tax or the self-employment tax itself on Schedule A. Fines or penalties. These include penalties for violation of a law, such as parking tickets, late payment penalties, or speeding tickets. These are non-deductible. And finally, licenses and fees. For example, marriage licenses, driver's licenses, dog licenses. These are not allowable as an itemized deduction. Password number 1 is MindMeld. 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 And we're on to the next exciting topic of the day, which is interest expense. Actually, I consider interest expense to be the holy grail of tax deduction. The reason I say that is it is generally, but not always, the case that the home mortgage interest deduction is impervious to the alternative minimum tax. It is one deduction that the alternative minimum tax cannot rob or take away from you. And so it can benefit people at all different income levels, including people who normally have deductions taken away from them under the alternative minimum tax. So we're going to start on this line of the 1040 now. And of course, interest expense is deducted on lines 10, 11, 12, 13, and 14 of Schedule A. We're going to be taking each of these lines in turn. And we're going to begin with line 10 in just a minute. But in general, you can deduct only 2 kinds of interest on Schedule A. And other types of business-related interest are not a part of today's discussion. You can claim a deduction for interest you pay for your first or second home mortgage, and you can also claim a deduction for investment interest to the extent that it does not exceed your investment income. Deductible interest expenses are reported on lines 10 through 15 of Schedule A. And the first of these lines, line 10, has to do with the home mortgage interest deduction. Interest you pay on a loan that is secured by your main home or your second home is home mortgage interest. You must meet these tests to claim a deduction for a mortgage interest that you paid. You must be legally liable for the loan, and there must be a true debtor-creditor relationship between you and the lender. The mortgage must be a secured debt with your home offered as collateral for that loan. Secured debt. You can deduct your home mortgage interest only if the mortgage is a secured debt. A secured debt is one in which you sign an instrument such as a mortgage deed of trust or land contract that makes your ownership in a qualified home security for payment of that debt. So it makes your ownership in a qualified home security for payment of that debt. And it provides, in case of default, that your home could satisfy the debt, and it is recorded or is otherwise perfected under state law or local law that applies. So in summary, your mortgage is secured debt if the home is used as collateral to protect the interests of the lender, and if you cannot pay the debt, your home can then serve as payment to the lender to satisfy the debt. So when is debt not considered to be secured by the home? Well, a debt is not secured by your home if it is secured solely because of a lien on your general assets, or if it is a security interest that attaches to the property without your consent, such as a mechanic's lien or a judgment lien. A debt is not secured by your home if it once was, but no longer is secured by your home. Let's look at this concept of a wraparound mortgage. I actually run across these fairly frequently. Clients get quite creative in what they're doing with home purchases and sharing homes between family members. And so we get into these situations with these things called wraparound mortgages. And if you're in a wraparound mortgage, odds are it's not deductible. A wraparound mortgage is a form of seller financing where the seller remains liable for the original loan. Payments are made by the buyer to the seller, who in turn makes payments to the mortgage holder. A wraparound mortgage is not a secured debt unless it is recorded or otherwise perfected under state law. And here is an example. It comes from IRS Publication 936 on pages 3 through 4. The following facts apply to a wraparound mortgage. Beth owns a home subject to a mortgage of $40,000. She sells the home for $100,000 to John, who takes it subject to the $40,000 mortgage. Beth continues to make payments on the $40,000 note. John pays $10,000 down and gives Beth a $90,000 note secured by the wraparound mortgage on the home. But Beth does not record or otherwise perfect that $90,000 mortgage under state law that applies. And because the mortgage was not perfected under the applicable state law, it is not a secured debt, and John cannot deduct any of the interest that he pays on it as home mortgage interest. So that's one example provided in IRS Publication 936, but I'll tell you what I usually run across. I'll run across a brother who decides to take out a loan to purchase a home for his sister who has bad credit. So her name isn't anywhere on the loan, because if it were, the interest rate would go way up, and the amount that they'd be willing to lend, the bank might be willing to lend, would be less for a higher interest rate. So brother decides he's going to purchase this under the auspices that it will be his second home. And he then allows his sister to move in. And so she starts making mortgage payments on that loan for him. And his attitude is, well, I bought the house for her. She's making the payments on it. It's her house. And she, of course, wants to be able to make those deductions. Well, the reality is, if the debt's in his name but he doesn't pay it, and the mortgage is not in her name and she pays it, then no one gets the deduction. So it's a really bad deal there. It would really be necessary to somehow construe or design the paperwork for this loan in such a fashion that she is going to be the owner of the home, and that he registers his debt with the state under the laws that they have in place, and make sure that the law is perfected in terms of how they arrange this deal. And if the law is perfected in that way, then he can show that this is a type of seller-financed mortgage where she actually has something that she can deduct. The choice to treat the debt as not secured by your home. So in order for it to be deductible as home mortgage interest, must be secured by the home. But there are certain situations where debt could be secured by the home and you choose not to deduct it as mortgage interest anyway. And that's what this particular paragraph is about. You can choose to treat any debt secured by your qualified home as if it was not secured by the home. This treatment begins with the year for which you can make the choice and continues for all later years. You can revoke your choice only with the consent of the Internal Revenue Service, and you may want to treat a debt as not secured by your home if the interest on that debt is fully deductible, for example, as a business expense, whether or not it qualifies as home mortgage interest. So let's just think about this a little bit. I have clients, a number of them over the years, that have purchased rental properties. And to purchase a rental property, you typically need a pretty big down payment, at least 20%. And it may be the case that a client doesn't have 20% cash to put down on a rental property, but they still want to buy it. On the other hand, they're living in a home that has a good amount of equity in it. So what they do is they refinance their home, and they take a certain amount of the money from that refinance and use it to put the down payment on this rental. So they have a loan secured by their main home that is partially for their original mortgage, plus an additional mortgage amount that is used to purchase the rental property. And so what you can do in a situation like that is figure out what the proration amount is. And let's just suppose you've got a home worth $300,000 and you take out a $200,000 loan against it, and at the time you did that refinance, the amount of debt you owed on that house was only $100,000. So you can now show that 50% of the debt is attributable to money placed on the rental property and 50% is attributable to the original mortgage. It would be legal to deduct all of it on Schedule A. But you could also make an election to take half of the interest every year and allocate that as rental interest on Schedule E. So you'd claim half on the Schedule A and half on the Schedule E. So what portion of my mortgage interest is deductible? Your mortgage is fully deductible to the extent that it fits into one of the following categories. So in other words, is it possible to pay mortgage interest that meets all of the tests? It's secured by your main home, it's properly recorded, you've made the payments on it. Is there a situation where it's still non-deductible? And it is possible that it's non-deductible. It doesn't happen too terribly often, but it can come up. So that's what this paragraph is about. So your interest is fully deductible to the extent that it is one of the following. Either grandfather debt, that is a mortgage you took out before October 13, 1987, not too many of those out there anymore, or it is home acquisition debt, mortgages that you took out after October of 1987 to buy, build, or improve your home, plus any grandfather debt that totals $1 million or less, half that amount if you're filing married, filing separately. And finally, home equity debt, mortgages that you took out after October 13, 1987, other than to buy, build, or improve your home, but only to the extent that the total of these loans was $100,000 or less and totaled no more than the fair market value of your home, reduced by 1 and 2. So the following charges are deductible, though, as mortgage interest. And with this particular category up here, The IRS does keep interest divided into two distinct categories. We're not really going to worry about this grandfather debt because I've never run across it. Just not out there anymore. So we're left with the home acquisition debt versus the home equity debt. And home acquisition debt is any debt that you took out at the time you acquired your home. And home equity debt is essentially a mortgage that you took out that was used other normally than to purchase the home. Sometimes you will use a first and second mortgage to purchase a home, and you might think of one of those lines as the equity line of credit. But really, the true definition of an equity loan is that it was used for something other than to buy the home. You have equity in your home, you borrow against your home, and you use that equity to buy a car or send your kid to college. That's an example of home equity debt. Let's look at some special situations where we could have charges that are still considered to be mortgage interest and are deductible as mortgage interest. And these include late payment charges on mortgage payments. If you made a late payment penalty on your mortgage, that penalty is interest and is deductible as mortgage interest. Also, mortgage prepayment penalty. You pay your mortgage off early, so you have to pay an extra amount because you paid it off early. It is deductible as home mortgage interest. Prepaid interest. However, you must spread this interest as a prorated amount over the life of the loan. Prepaid interest is usually referred to as points. Ministers and military housing allowance. Even if you are exempt from tax on your housing allowance, you can still claim mortgage interest you paid as an itemized deduction. And divorced or separated individuals, if your divorce decree requires that you pay the mortgage on a home jointly owned by you and your spouse, but you do not live in the home, 1/2 of the mortgage payment may be considered alimony. You may deduct half the mortgage interest paid as an itemized deduction. Mortgage interest payments that are not deductible. Certain types of mortgage interest payments are not deductible. And these include mortgage proceeds invested in tax-exempt securities. You're not allowed to claim a home mortgage interest deduction on grandfather debt or home equity debt if you use the proceeds of the mortgage to buy securities or certificates that produce tax-free income. Reverse mortgages. This is one that I've seen confuse a few tax preparers over the years and tax clients as well. A reverse mortgage is a loan where the lender pays you either in a lump sum, a monthly advance, a line of credit, or a combination of all three of those, while you continue to live in and retain ownership of your home. And the following facts apply to reverse mortgages. The money you receive from the lender is a loan and is therefore not considered to be income to you. Interest accrues on the money that lender gives you. However, it is not deductible until you actually pay it. A reverse mortgage typically becomes due with interest when you move out of the home, sell the home, reach the end of a pre-selected loan period, or you die. And any interest, including original issue discount that is accrued on a reverse mortgage, is deductible when you actually pay it, which is usually when you pay the loan off in full. A reverse mortgage is generally a form of home equity debt, which means that your deduction may be limited if the amount of that debt exceeds $100,000. So if you've got your parents who've been living in a home worth $300,000 and they've been on a reverse mortgage for the last 15 years with fairly heavy interest rates and things not working terribly in favor of your parents, it could be the case that when they decide to sell that house that they could have $150,000 of debt that they've acquired, and that debt would all be considered to be equity debt. So in the year that it gets paid off, they would only be able to deduct interest on the first $100,000. They wouldn't be able to deduct interest on the full $100,000 of debt, for example. Refunds of interest. The following rules apply to refunds of home mortgage interest that you received during the year. If you receive a refund of interest in the same year that you paid it, you must reduce your interest expense by the amount that was refunded to you. And if you receive a refund of interest you deducted in an earlier year, you generally must include the refund in income in the year you receive it to the extent you received a tax benefit from deducting it in the earlier year. If you received a tax benefit from interest deducted in an earlier year and the interest is refunded to you, the interest is taxable regardless of whether it is refunded to you as a cash payment or used to reduce the outstanding principal on your mortgage. If you need to include a refund of interest in your income, you should report it on Form 1040, line 21. And if you received a refund of interest that you overpaid in an earlier year, you will generally receive a Form 1098 mortgage statement with an amount shown in box 3 of that statement. Prepaid interest. If you pay interest in advance for a period that goes beyond the end of the tax year, you typically must spread this interest out over the years to which it applies. You conduct in each year only the interest that qualifies as home mortgage interest for that year. However, there is an exception for points, and we'll talk about that in a moment. For divorced or separated individuals, if a divorce or separation instrument requires you or your former spouse to pay home mortgage interest on a home owned by both of you, the payment of interest may be alimony. And here is an example where it is alimony. Pursuant to her divorce decree, Reba made mortgage payments on a home jointly owned by herself and her ex-spouse. And during the year, Reba paid $24,000 in payments on that mortgage. The payments were applied as follows. Mortgage interest, $15,000, real estate taxes, $5,000, hazard insurance, $1,000, principal payment on the loan, $3,000. You total all of these amounts up, $24,000 of expense there. Now, Reba is not able to deduct all of the mortgage interest she paid because she made payments on a property that is 50% owned by her ex-spouse. Instead, she will be allowed to claim the following deductions relating to payments on her home. Reba's mortgage interest deduction will be limited to $7,500 or 50% of the mortgage interest paid. She will be able to claim a deduction for taxes paid of $2,500, which is 50% of the taxes paid, and she will be able to deduct $12,000, which is half of $24,000, as an adjustment to income for alimony paid. Now, this isn't really a precise illustration here unless this was like an interest-only loan. Typically, when you are in a divorce situation and you are making a payment on the mortgage, if you're paying the full mortgage, part of that mortgage is going to be going to escrows for insurances. Part of it is going to be going to principal. Part of it is going to be going to interest. So it could be that 50% of the entire payment is deductible as alimony, and then of the then you would go in and look at the mortgage interest and claim half the mortgage interest as a deduction on Schedule A. So half the total payment would be alimony and deducted as alimony, and half the interest would be deducted on Schedule A as mortgage interest. Now, Reba's ex-spouse will report the following amounts on his return. He will claim a mortgage interest deduction of $7,500, which is half the mortgage interest paid. He'll claim real estate taxes paid at $2,500, and he will report alimony income of $12,000. An itemized deduction is not allowed for the hazard insurance or principal payments that is made on the loan, however. And to the extent that Reba paid these amounts for her ex-spouse, they are alimony deductions to her and income to her spouse. So let's take a look at the 1098 mortgage interest statement. This is one of the more common statements that you should be seeing each year, and most mortgage companies do nothing to alter the general appearance of the form. In other words, you don't typically see an alternate format or a substitute format with mortgage interest statements the way you do with investment income statements like 1099 DIVs and 1099 INTs and 1099Bs. Those usually come out in some kind of a substitute format. But the 1098 mortgage statement usually looks like this when your client walks in the door with it. And box 1 is where you're going to report the mortgage interest that was received. Box 2 is where point paid on purchase of the home will be reported. Box 3 is where a refund of overpaid interest that is taxable income to the filer will be reported. And box 4 is blank. Historically, it is the box used to report mortgage insurance premiums. But because the mortgage insurance premium deduction had expired at the end of 2013 and was not resurrected until the very end of 2014, IRS did not reconfigure box 4 to indicate that it was for mortgage insurance premiums because technically that deduction had expired. But for years prior to 2014, box 4 was used to report mortgage insurance premiums. And what I saw in with preparing 2014 returns is that the mortgage companies continued to report mortgage insurance premiums in box 4. And then box 5 is used for anything that the mortgage company wants to use it for. And often real estate taxes are shown in this box, but it could be used for other things as well. And there's one particular bank, Bank of America, that never seems to use this box. I always have to take the Bank of America mortgage statement, flip it over, and look in the top left-hand corner on the back of the form to find the real estate taxes paid. But other mortgage companies will routinely use box 5 for property taxes. If you don't see real estate taxes appearing on Form 1098, then the question that should naturally flow from you to the client is, are you paying the taxes directly or are they coming from your mortgage? Because if they're coming from your mortgage, I'm not seeing them in the box, Maybe there's somewhere else on the statement. You can flip it around and find it somewhere. But there's no requirement that the mortgage company report them on the 1098. It's just the case that mortgage companies often do. So that's a deduction you should be searching for if you don't see it in box 5. Now, what about mortgage interest that's not reported on the 1098? The IRS actually has separate rules for how you claim a deduction for mortgage interest when it's reported on a 1098 and when it's not. If it is reported on a 1098, you claim the deduction on line 10. But if you paid mortgage interest on a loan not reported on a Form 1098, then the IRS wants you to use line 11. So if you pay mortgage interest directly to the seller of your home, you are paying a seller-financed mortgage, and generally you will not receive a 1098 mortgage interest statement on a seller-financed mortgage. Therefore, you're going to have to provide additional information about the lender to the IRS directly on Schedule A. And here we have a situation where we've got seller-financed mortgage. The interest payments are being made to Wilma Deering. This would be her Social Security number, and this would be her address. So the IRS is wanting the name, Social Security number, or the EIN number of the person you are making the payments to, as well as their address. Now, the other time that I use this line, and I actually use it fairly often, it may or may not be quite within the intention of the form, but it's how I do it anyway. When you have a client that claims a deduction on Schedule A and the 1098 that they've received does not have their Social Security number on it, right here, it says payer Social Security number. If they have a 1098 and they made all of the payments on the loan, and you can see that they are the ones who are entitled to the deduction, or maybe it's a co-owned home with a taxpayer and spouse, and they're filing separately, and you've got the taxpayer whose Social Security number appears on the form and the spouse's doesn't, but they were both liable for the debt and they both made mortgage payments on the debt. What's going to happen if you then go over to Schedule A and make an entry on line 10 for the person whose Social Security number does not appear on that 1098? Well, odds are it's going to trigger a letter from the IRS, a CP 2000 letter. The IRS is going to say, hey, your tax return claims a deduction. We see no corresponding 1098. We don't think you're entitled to that deduction. You need to explain to us or prove to us why it is you're entitled to that deduction. And then, she's going to have to track down, the spouse will have to track down evidence that they were liable for the debt and that they, in fact, paid the debt and send all that in. Well, that can be a royal hassle. It's stressful to the client, and it's predictable. It's totally predictable that that's going to happen. And so when I'm in a situation where I know my client is legally entitled to their deduction, but their Social Security number is not the Social Security number that is on the 1098, I'm going to assume that they are essentially reporting a deduction for an amount that is not on a 1098, at least not in their name. And so I'll end up putting the information pertaining to that 1098 on line 11 rather than on line 10. The other place that I often use line 11 is when there's a deduction being claimed for, say, a motor home. Motor homes qualify as second homes. Travel trailers can qualify as second homes. To meet the definition of a second home, they simply have to provide sleeping and cooking facilities. I think they're supposed to have a bathroom as well. So once you've got all three of those things in the unit, then it does qualify as a second home. But the loans on travel trailers and motor homes are not mortgages on which those lenders are going to issue 1098s. So when I do have a client that's claiming a deduction for interest on a motorhome loan that qualifies as their second home, I'm going to get the information for the lender and enter that on line 11. And that very often just involves calling the lender that the loan is under and getting that information. Points are the next topic that we're going to look at, and points are a form of prepaid interest. Generally, you must amortize points you pay over the life of the mortgage loan. There is an exception where the points are fully deductible. You can fully deduct points in the year they are paid if they meet all of the following tests. Number one, the loan is secured by your main home. You must amortize points you pay on your second home. Paying points is customary for the area in which you live. The points charged were not more than the points generally charged in your area. You used the cash method of accounting. The points paid were not a substitute for other common closing costs such as escrow fees, down payment, title fees, etc. And the funds you provided at closing were at least as much as the points charged. You use your loan to buy or build your main home or to improve your main home. The points were computed based on a percentage of the principal amount of the loan, and the amount is clearly shown on your closing or settlement papers. If you meet all of these tests, you can choose to deduct points in the year you pay them, or you can amortize them over the life of your loan. For refinancing, however, the following rules apply to points that are paid on a refinance of your home mortgage. Generally, you must amortize points you pay to refinance even if the new mortgage is secured by your main home. And if you amortize your points, you can claim a deduction for points as a prorated amount each year. And finally, if you pay your mortgage off early, you should claim a deduction for unpaid points in the year you pay off the loan. And I'll show you an example of that in just a second. For mortgage ending early, if you spread your deduction for points over the life of your mortgage, you can deduct any remaining balance in the year that the mortgage ends. A mortgage may end early due to prepayment, refinancing, foreclosure, or a similar event. And there is an exception. If you refinance the mortgage with the same lender, however, you cannot deduct any remaining points for the year. Instead, you deduct them over the term of the new loan. And here is an example where the balance of points is deductible in the year it is paid off. Dan paid $3,000 in points in 2007 that he had to spread out over the 15-year life of the mortgage. He had deducted $1,400 of these points through 2013. Dan prepaid his mortgage in full in 2014, and that means he can deduct the remaining $1,600 of points in 2014. And when you go back up to Schedule A, you will see here that there is a line 12, points not reported to you on a Form 1098. But when you go up to line 10, it says home mortgage interest and points reported to you on a 1098. If the points are reported on 1098, you enter them on line 10. And if the points are not reported on a 1098, you enter them on line 12. Now, sometimes I see situations where a person has purchased a new home and they've paid points on the purchase of that home, and the points are not entered on the 1098. They should have been, but they're not. So that would be an example where you put it on line 12. But other times, an individual may not have points reported on a 1098 because they actually are amortizing them over the life of the loan. Perhaps they paid points on a refinance. And if they're paid on a refinance, and let's just suppose you paid $3,000 of points as a form of prepaid interest on a 30-year loan, well, you're going to be allowed to deduct $100 a year each year until that loan is either you sell the home, refinance the home, or just pay the loan off. So you're going to be deducting those points as you go each year, typically at a rate of $100 a year. I've seen some tax practitioners actually create an amortization schedule in the software to record those points and carry them forward each year. That's not how I do it. I simply use expanded detail screens for the line that I'm entering on. So if I double-click, for example, on the Drake software that I use for points not in a 1098, I'll go into the field that I open and I'll say the year that the loan came out. I'll do the amortized amount, the amount that's a deductible amount each year, and the year that I started doing that. And then I'll figure out what the yearly annual deduction is, and each year when I go to that screen, I'll see what the amount is that I'm allowed to deduct. And then in the year my client pays that loan off, I do the math, figure out what the allowable deduction is, and claim the difference. Now, we've had a few years now where interest rates have been incredibly low. Really, ever since the collapse in our economy, the Great Recession that started in 2008, I have seen not a lot going on in the way of points, at least in my area here. Now, in the 90s and the 2000s, all kinds of points were flying around. I had clients paying exorbitant amount of points. It was not at all uncommon to see a client pay up to 3 points to purchase a house because they were considered to be high risk. But since the Great Recession started, and following the Great Recession, interest rates have just been so extraordinarily low that I'm actually seeing situations where my clients frequently are paying no points at all. And there could be a small loan origination fee that's being assessed, and then the lender actually credits that back and ends up charging them nothing for the loan. So it's important to kind of just pay attention to what's trending in a particular economy at a particular period of time. And the illustrations that I'm showing you in the manual today that I'm about to show you really come from a period of time where larger amounts of points were fairly common. And who knows, down the road we may see this era or this type of situation return. But at this point in time, throughout my long lecture on points, how to identify them, how to figure the deductible amount, you should just simply be aware of the fact that a lot of people just aren't paying points right now when they purchase houses or refinancing them, or if they are paying them, it's a tiny, tiny number. But let's take a look at what I've got here to show you. There's 2 different ways that points get paid. One is that the points are paid by the seller of the home. You buy the house, and the seller says, you know what, I will pay the point for you. You want to borrow at a rate of 3.5% and it's going to cost you a percent point to get to that, I'll pay that to help you buy the house. That's fairly common with new construction. It's not at all uncommon for builders who are building neighborhoods to have those kinds of incentives to get people to sign on the line and buy a new home, where the seller pays the points. And if the seller pays the points for you, you are treated as having paid them yourself. And you're going to reduce your cost basis in the home by the amount of points that the seller paid for you. And you will claim the points as a deduction on your Schedule A. But if you are the seller and you pay points for the buyer, you are not allowed to claim the points that you paid for the buyer as a deduction. Instead, the points you pay increase your basis in the property and reduce your net profit from the sale. So let's just suppose we've got a home that sells for $300,000 and the points paid on it are 1% or $3,000, and the lender is paying the point for the buyer. The buyer will be able to deduct that $3,000 as a deduction on Schedule A for points paid, and the lender is going to in turn reduce the amount of income from that sale. So if the sale was $300,000, the lender is going to treat that sale as $300,000, but is going to increase the cost of that sale by $3,000. So the builder spent $200,000 building that house, marketing that house, and then determines that there's another $3,000 of points allocable to that house. It's going to increase the cost to the builder to $203,000. So that's essentially how the math works. So let's look at a sample settlement statement. This time we're looking at points. And in the earlier part of today's class, we actually looked at the proration of property taxes. And now we're going to be studying points that appear on a settlement statement. And here we are on line 801. And we can see that on line 801 that 1 percentage point has been charged, and the amount that's been charged as points is $1,519. So this $1,519, it's being called an origination charge, and that's what's interesting. When you look at these settlement statements, you will not normally see the word point, although I have started to see some of these statements say your credit or charge, and then it's got brackets around the word points for the specific interest rate chosen. Up here it says loan origination charge 1%. Whether it calls a loan origination charge or points paid, it is points only if it is based on a percentage of the loan amount. So we're assuming here that the amount of money being borrowed is $151,900. And a 1 point charge on that loan gives us $1,519, and that is the amount that is going to be deductible as points paid. Now, most settlement statements are going to have another line for interest lower down on the form, and you can see here it says line 901, daily interest charges. It is quite normal at the time you purchase your house that the first payment that you will make after you purchase that house could be a month or two off in the future. So if you close in the month of June, it could be that no payment is due in June or July, and the first payment is going to be due in August. And where that comes up, there's going to be a figuring going on for how much interest is attributable to a period of time where no payment is being made. And they're going to assess that interest at the time you buy and ask you to bring it to the table at close. So any amount that you see in here as a daily interest charge, that is not points. You're not going to deduct it as points. And I wouldn't even pull it off the settlement statement at all, because whatever amount you see here as daily interest charges, that should be included in the 1098 later in the year. This is just showing how much interest is being charged each and every day and how much they're wanting you to bring into the table at close. But from the time that this loan closes until the end of the year, that mortgage company is going to be tracking the amount of interest you paid, giving you a 1098 at the end of the year, and that 1098 is going to be what you refer to for your deduction. So the next line we're looking at now is Schedule A, line 13 for mortgage insurance premiums. You may be able to treat mortgage insurance premiums you paid during 2014 as home mortgage interest subject to the following rules. The mortgage interest must be paid in connection with home acquisition debt. The mortgage insurance contract must have been issued after December 31, 2006, and you must have paid the premiums before 2015 for coverage in effect during 2014. And as I said, this was a deduction that had expired for 2014. IRS went ahead and designed Form 1098 without a provision for a line to record this information. Then the law was retroactively extended through 2014, and so mortgage companies continued to use Box 4 of Form 1098 to report the amount. Going into 2015, as we sit here in 2015, this is an expired provision, but there's every reason to anticipate it'll probably get extended again. Who knows? We'll see at the end of the year. There is a deduction limit for home mortgage insurance. You cannot claim a deduction for home mortgage insurance if your income surpasses a certain threshold amount. And if your adjusted gross income on line 38 of your Form 1040 is more than $100,000 or half that amount if you are filing separately, the amount of your mortgage insurance premiums that are otherwise deductible is going to be reduced and finally eliminated. If your adjusted gross income on Form 1040 line 38 is more than $109,000 or half that amount for filing separately, you cannot deduct mortgage insurance premiums at all. I haven't really seen this particular deduction adjusted for inflation, so it's been around for pretty much a decade or longer and never been adjusted for inflation, so it's kind of just as house prices go up and interest or incomes go up, this deduction is having less effect anyway. I have a lot of clients that just simply earn too much to benefit from it. So there is a worksheet that the IRS provides to determine what your allowable mortgage insurance deduction is. It simply applies the income levels. So it says start on line 1 with the amount of mortgage insurance premiums you paid. Enter your adjusted gross income. Enter $100,000. If your adjusted gross income is greater than $100,000, you do a subtraction. If your adjusted gross income is less than $109,000, you're going to be allowed a partial deduction, and if your income exceeds $109,000, you will be allowed no deduction at all. So here's an illustration of how we figure the deduction for interest and taxes for a particular filer. His name is William Rogers. He has wage income of $102,000 for the year, and during the year, back in April, William purchased a new home in Columbus, Ohio. He paid the following expenses for the year: personal property tax on a car of $600, a balance due to Ohio on his 2013 return in the amount of $400, Ohio State withholdings in Box 16 of the W-2 for $4,000, property taxes that he paid on a home that was owned by his mother, $1,200, interest paid on a credit card with Bank of America used for home improvement items, $200, and interest paid on a travel trailer loan with Bank of America for $800. The EIN and address of a Bank of America is shown here, and William's HUD statement is also attached. Prepare his Schedule A as shown next. And you can see here that we have his 1098 showing $12,000 of mortgage interest received, $3,000 of points paid on purchase. Mortgage insurance premiums were $2,000. Property taxes were $1,500. The amount of mortgage insurance premiums paid by William for the year is $2,000, and the taxes that he paid during the year are $1,500. These came from his escrow account, as you can see here, so they're going to be deductible. But this amount here, because his income is more than $100,000, his mortgage insurance premium deduction is going to be limited. So let's look to his HUD statement. When we look at his HUD statement, we can see here on line 107 that there's a county tax proration going on for the period of April 1st through June 30th in the amount of $750. Ohio assesses taxes annually with one $1,500 payment due in February and a second annual payment of $1,500 due in July. And since the seller paid $1,500 in February and then sold the home in April, William, as the buyer, needs to pay the seller $750 for those property taxes that are attributable to the period that he owned the home. So this $750 is going to be deductible to him, as is the next $1,500 that he pays in full in July. We then move over to the next page of the settlement statement, and on this page we can look at the loan origination charge. It was 1%. He paid $3,000, and that amount is going to be deductible to him as points paid. So it all actually lines up nicely with his 1098 mortgage statement, but the mortgage statement up here for the property taxes is only showing the amount that went out of escrow in July. It is not showing the additional amount that was paid out at the time he purchased the house through the settlement. So let's move over to the Schedule A and see what's going on. On line 5, he's going to enter the $4,000 of income tax that was withheld on his W-2, plus he's going to deduct the $400 that he paid as a balance due for his 2013 Ohio return. On line 6, he's going to enter the $750 of real estate taxes that he paid on the close or purchase of his home. He's also going to deduct the $1,500 that came out of escrow later in the year. So his total real estate tax deduction is $2,250. And then he paid $600 of personal property tax. That is deducted on line 7. His home mortgage interest statement shows $15,000 of deductible amount. $12,000 of that is mortgage interest, and $3,000 is of points. And so you add $12,000 plus $3,000, you get that $15,000. He also has a loan on his travel trailer, and that qualifies as a second home. And I've entered the Bank of America information on line 11, and he's going to claim his deduction for interest on that travel trailer on line 11. And then finally on line 13, he's claiming a deduction of $1,600 for mortgage insurance premiums that he paid. When we go back up to that 1098, we can see that the mortgage insurance premium he paid was $2,000. So how much is he going to get to deduct? Well, he's going to get to deduct $1,600, and how do we figure that? We're going to go over and do the mortgage insurance premium worksheet. It shows $2,000 of home mortgage insurance paid. It takes his adjusted gross income of $102,000, subtracts out the limit of $100,000, and the difference is 20%. He is 20% into the phase-out range, and that means that 20% of the mortgage insurance premiums he paid are non-deductible. 20% of $2,000 is $400. You subtract $400 from $2,000, you're left with $1,600. $1,600 is the amount he's allowed to claim as a deduction on line 13. I have a little note down at the bottom of the page. It says, do not claim on Schedule A the following non-deductible expenses that William Rogers paid, including $1,200 of real estate taxes for the mother's home. Although William paid these taxes, they were not assessed against property that he owns, and therefore he cannot claim a deduction. Also, $200 of interest on the credit line that he used for home improvements. Although the debt was incurred for home improvements, it was not secured by the home, and therefore it is not deductible. The next item we're going to look at is qualified investment interest. This is deducted on Schedule A, line 14. Investment interest is interest that you pay on money that you borrowed for investment purposes. If you borrow money to purchase stock or other investment property, you have investment interest. Investment interest is deductible to the extent you have investment income. Typically, when you're looking at brokerage statements provided by investment firms, investment interest is referred to as margin interest, but it could be that you've borrowed money from other sources outside of the brokerage firm, and if you did that, you would need to track your investment interest on your own. There is a limit on the amount of investment interest deduction that you are allowed to claim, and it is typically equal to your net investment income. So what is investment income? Well, income you derive from property you hold for investment is investment income. The income can come in the form of interest, dividends, annuities, royalties that are not derived in the ordinary course of a trade or business. Net investment income does not generally include capital gain income or qualified dividends. However, you can choose to treat or include part of this type of income as investment income. And if you do so, you need to complete Form 4952 and show how much of this type of capital gain income you are choosing to treat as investment income. If you choose to include any of your net capital gain or qualified dividend income as investment income, then that portion that you treat as investment income is not eligible for the lower capital gain rate, usually 15%. Before making either choice, you should figure your tax on capital gains with and without Form 4952 to figure your lowest overall tax. So non-deductible investment interest expense. Investment interest expense is deductible only to the extent that the interest is related to the production of investment income, and the following kinds of income are not considered to be investment income for purposes of this deduction. Firstly, we have tax-exempt interest income, interest expenses on straddles, Alaska permanent dividends, passive activity income, income from the active conduct of a trade or business, and royalty income derived from the active conduct of a trade or business. So any kind of interest expense you have associated with these kinds of income activities is not going to be deductible as investment interest expense. You do need to allocate your investment interest expense. If you borrow money for business or personal purposes as well as investment, you must allocate the debt amongst these purposes. Only the investment expense on the part of the debt used for investment purposes is treated as investment interest, and the allocation is not affected by the use of the property that secures the debt. For example, Allocation of investment interest expense, and this particular example comes out of publication 550. You borrow $10,000 and use $8,000 to buy stock. You use the other $2,000 to buy items for your home. Since 80% of the debt is used for and allocated to investment purposes, 80% of the interest on that debt is investment interest, and the other 20% is non-deductible personal interest. So how do you go about deducting investment interest? Well, you can use Form 4952 to report your investment interest deduction. You report your deductible interest expense on Form 4952 and also on line 14 of Schedule A. You then carry your disallowed deductible interest expense forward to 2015, or you can claim a deduction for your investment interest expense on Schedule A, line 23, subject to a 2% limit on the miscellaneous deductions. There is an exception to using Form 4952, and that is you are not required to use the form if you meet all of the following tests. Number one, your investment interest expense is not more than your investment income from interest and ordinary dividends. Number two, you have no other deductible investment expenses. And number three, you have no disallowed investment carryover interest from an earlier year. And here is an illustration of what I mean in completing Form 4952. We have Austin Powers, who has the following investment and capital gain income for the year. He has a 1099 INT showing Box 1 ordinary interest of $100. He has a 1099 DIV showing Box 1A ordinary dividends of $200. So Box 1 of both these forms is considered to be investment income. So you'd start off thinking, okay, he has $400 investment income. But we continue looking at the 1099 DIV, and we can see that Box 1B has qualified dividends of $200. What that means is that of the $300 in Box 1 of the 1099 DIV, only $100 is actual ordinary dividend income because $200 is qualified dividend income. Also on that same 1099 DIV, he has a capital gain distribution showing in Box 2 of $300. So ultimately, his capital gain income is going to be $200 plus $300, and his investment income is going to be $100 plus $100, or $200. So interest of $100 plus ordinary dividends of $100 gives him $200 of investment income. He then has qualified dividends of $200 plus capital gains of $300, giving him capital gain income of $500. The total investment plus capital gain income is therefore $700. Now, Austin has $200 of investment income, $500 of qualified and capital gain income. He can choose to treat that capital gain income as investment income if he wants to. Now, during the year, Austin paid $800 of margin interest through his investment brokerage account. He also paid investment interest expense carryover from 2013 in the amount of $100. So let's prepare his Form 4952 as I'm going to show you here. We begin by looking at line 1, and on line 1 we enter the amount of interest expense he had for the year on his investments, and that was $800. Then on line 2 we show the carryover from 2013 of $100, and that means that the total investment expense he has for 2014 is $900. We then go over to line 4A, and it says enter the gross income from property held for investment. And that would be the total of Box 1 of Form 1099 INT plus Box 1A of Form 1099 DIV. You add those two numbers together, and you get $400. The next step says, well, how much of the investment income shown on line 4A is for qualified dividends? And the answer is $200, so we pull that amount out. And then it asks, how much is your capital gain income? And that was $300. So ultimately, $400 is reduced by $200, leaving a $200 net investment income amount. And the $200 is then added to the capital gain income to give $500 of income that is capital gain or qualified dividends. But on line 4G, this is where Austin can make an election to have that capital gain and qualified dividend income treated as if it was investment income. And he's going to do that. So he's going to enter $500 on line 4G. When you add the $500 on line 4G to the $200 on line 4C, you've got the total amount of investment income he has for the year. And he is going to be allowed to deduct investment interest to the extent he has investment income. So ultimately, he will be allowed to claim a $700 investment interest expense on Schedule A, and he will have a $200 carry forward of disallowed interest that will carry forward to the next year. Here is a summary of where to deduct your interest expenses. Although you can deduct certain interest you paid on Schedule A, you may need to deduct interest you paid on another form or schedule instead. In deciding where to deduct interest, you should consider whether the interest was personal or business to you. And here is the type of interest and where you can deduct it. We begin with student loan interest. It is not deducted on Schedule A. If it is deductible, it is deducted on Form 1040 as an adjustment to income, and that would be on line 33, or if you're filing the short Form 1048, it would go on line 18. Deductible home mortgage interest and points that are reported on a Form 1098, those go on Schedule A, line 10. Mortgage interest not reported on 1098 goes on line 11, and points not reported on a 1098 go on line 12. Mortgage insurance premiums go on line 13 of Schedule A. Investment interest that is not incurred to produce rents or royalties goes on Schedule A, line 14. And if you pay interest associated with a business, then it goes on Schedule C. If you pay it associated with a farm, it goes on Schedule F. If you pay interest incurred to produce rents or royalties, that is claimed on Schedule E. And any other form of personal interest like credit card interest or car loan interest, it's not deductible at all. So that concludes the interest portion of today's class. It's time for the second break of the day and the second password of the day. But I'm also, before I send you away on your break, going to show you a classwork assignment that I have in here. And it's near the back of the manual after charity. If you scoot over to page 60 of the manual, you will see a classwork assignment in here. And during the 10-minute break I'm going to give you could think through this assignment a little, and then after the break I'm going to show you the answer key. Here we have a character named Leonard Baker who is married to Sue Baker. And in March of 2014, the Bakers bought a new home located in San Francisco, California. They have a son, Mark, who lived with them all year. Mark earned $8,300, but his parents paid more than half the cost of his support. The Bakers were both covered all year by a health plan at Leonard's work, and during the year, the Bakers had the following income and expenses. Income for the 2013 taxable state refund that they received in 2014 was $400. They had unemployment compensation received by Sue in the amount of $2,500. This is Leonard's W-2. It shows wages of $56,575, and it shows state income tax of $2,300 was held out. He also paid SDI, that state disability tax, to the state of California in the amount of $566. And they've received this a consolidated 1099-B statement. If you look at it, it shows ordinary interest income of $900, U.S. bond interest of $700, tax-exempt interest of $500, and ordinary dividends of $200. When you go down below, this is a summary of the account information. It really shows a breakdown of where those income figures came from. In addition to that income, there were some expenses, and the expenses for the Bakers were as follows. They had property taxes that they paid on closing papers from when they purchased their house of $933. They had title and recording fees that they paid on closing of $1,800. They paid sales tax on a trip that they took to Nevada in the amount of $200. Margin interest paid on an investment account totaled $800, and interest paid on land held for investment totaled $2,000. The Bakers each contributed $2,000 to their traditional IRAs, prepare their federal return. Here is their mortgage statement. It shows $10,500 of mortgage interest. It shows $2,500 of points. It shows mortgage insurance premiums of $1,632 and property tax in the amount of $2,800. Password number 2 is Tribble, T-R-I-B-B-L-E, Tribble. I'm going to pull up the answer key now for the Bakers, and here is the answer key. It's written in kind of a descriptive format first, and then we have the forms later on. What we're interested in is what can be deducted on Schedule A, why and how much, and I've listed those first. We're going to be able to deduct the property taxes paid in November. We're also going to be able to deduct the property taxes that were paid at close, and the state income tax on the W-2, and that SDI tax on the W-2. So the total amount of taxes that can be deducted on Schedule A is $6,599. We then move on to the interest section and decide what can be deducted there. Mortgage interest of $10,500, points paid on purchase $2,500. Investment interest, the deductible amount that we're going to be able to claim, $1,800, and the qualified mortgage insurance premiums is $1,632. But we're going to need to go and show you how we calculated some of these amounts. For example, this investment interest expense, how did we compute that number? Well, to figure that number, we first have to look at the Form 4952 and figure out what amount of investment interest was paid during the year. Now, one of the things that catches people is the concept of interest paid on vacant land. And you can pretty much assume that vacant land could never be your second home because it's empty. There's no house on the land, right? That's why it's vacant. And so although the vacant land is property that could be secured by a mortgage, it is not a mortgage on a home. And therefore, the interest paid on vacant land would not qualify as home mortgage interest. It's possible, if the land is being held for investment purposes, and we're going to assume that in this case, that that vacant land, the interest paid on it could be deducted as investment expense. Now, one of the things I should tell you is that it is possible at the time you acquire vacant land to make a decision to capitalize your interest and not deduct it at all. Whether you capitalize it and deduct it at the time you sell it, or whether you decide to claim it as investment interest expense and carry it forward over time, either way, you're essentially deferring that interest to a later point in time. But in this situation, we're going to assume that he's going to be attempting to deduct it, and so we're going to have to complete a Form 4952 to determine how much investment income the Bakers have as opposed to how much investment interest expense they have. So the investment expense they have, or the investment interest expense they have, is the margin interest that was paid on their brokerage account or their investment account, as well as the interest that was paid on that land held for investment. And when you add those two amounts up, you have $2,800. We know that investment interest expense is deductible to the extent there is investment income. So that's where we move over and look at the types of investment income that the Bakers had. And I'm going to just hide this for a quick second so we can return to the problem. And when we look at the second page of this problem, we see that we have investment interest in box 1 of $900. We have ordinary interest in box 1 of $900. And we have U.S. bond interest of $700. We're going to add those two numbers together. And when we do that, we get $1,600. We're then going to move over to the 1099 DIV, and we're going to see that we have $200 of ordinary dividend income. So that $200 plus the $1,600 is where we get $1,800. And this tax-exempt interest amount down here, that's not includable as investment income. So we're going to go back to the answer key again, and we're going to see that this is where I get that $1,800 figure for investment income. And now we're going to move over to their 4952. And on the 4952, we're going to enter $2,800 of investment interest expense. On line 4, we're going to enter the investment income. And, of course, the investment income is less than the investment interest expense, so they're going to be left with a $1,000 carry forward and a deduction amount of $1,800. So we're going to go up to the Schedule A, and on line 14, we're going to enter that $1,800. Now, for the income taxes, remember we had SDI tax withheld on the W-2. We also had income tax to the state of California withheld on that W-2, and they totaled $2,866. For the real estate taxes, there was real estate taxes that came out of their escrow and is shown on the 1098 statement, but there's also additional property taxes they paid on purchase. You're going to add those two numbers together. You get $3,733, and that is the amount to enter on line 6. Their mortgage statement, they're going to claim mortgage interest shown in box 1 of the 1098, and they're going to add to that point shown in box 2 of the 1098. Those total $1,300. Their mortgage insurance premiums are allowed in full because their income is not above $100,000. In fact, when we go up to page 1 of the 1040, we're going to see that the total income that they have for the year is $61,000. They are also claiming an IRA deduction of $4,000, so that bumps their income down to $57,275. So their mortgage insurance premiums are allowed in full. And so we enter the mortgage insurance premiums on line 13. When we add up all of the deductions, they're left with $23,031 of itemized deductions, and those carry over to line 40 of their personal return. We carry through, figure their tax. We put in the amount of federal tax withheld on their W-2, and they're left with a $959 refund. So that concludes the review of the classwork assignment for today's class. Go to page 40 of your manual. And on page 40, we're going to begin this last part of today's class with a discussion of charitable contributions. And when you claim contributions on Schedule A, they are claimed on lines 16, 17, 18, and 19. And we're going to be talking about those lines now. firstly, to claim any kind of a deduction for contributions to charity, you must make those contributions to a qualifying organization. And to become qualified, an organization must generally apply for nonprofit status with the IRS. An organization other than a church or government organization must apply to the IRS to become a qualified organization, and you use the following resources to determine if an organization is a qualified organization. Firstly, you can start by asking the organization whether it is a qualified organization, because most organizations will be able to verify their status. Now, I've run across some small churches that really don't know whether they're qualified organizations at all. But according to the information I'm reading, it says an organization other than a church or government organization must apply for status. So if they are a church, then technically, according to that instruction, they're not required to seek out status, and you could assume they have it automatically. But churches must still behave in a manner that is allowable. And for this reason, for example, churches are not supposed to engage in lobbying or political efforts, because if they do, then they're not considered to be qualified organizations. So most churches would qualify as a qualified organization, and if it's not a church or if it's not a government organization that you're making a donation to, then you really need to verify whether it is a qualified organization by going to the IRS website. And I have a link to the website here. If you click on that, then you can actually type the name of the organization to determine if it is listed as a qualified organization. Finally, if none of those options work for you, you can always try calling the IRS at the number shown here to determine if the organization is qualified. I would assume you'd be on hold for a long time based on the service level with the IRS lately. Contributions from which you benefit. You cannot claim a deduction for a contribution you make to an organization to the extent you benefit from the contribution. And cash contributions. These are claimed on Schedule A, line 16. You cannot deduct a cash contribution regardless of the amount unless you have a record such as a canceled check or a bank statement that shows the name of the charity, the amount you donated, the date, and or a written communication from the charity. And I have this bell ringer here. I would say that this is a good example where you may not have allowable deduction, because the rule is stating that you have to have some written evidence of the contribution to the charity. And if you're responding to the ringing bell Santa outside department stores and putting, $5 or $10 into that little tub, you have made a contribution to the Salvation Army, and that is a qualified organization. But are you allowed to deduct it? Well, you'd have to be able to show through some form of written record that you made a contribution to a qualified organization. And if you put cash in there and didn't get a receipt, you have no evidence of the contribution. So you could, I suppose, write a check and put it in there instead, and then you would have evidence. You could ask that ringing bell Santa to write you a receipt, but that's not normally done. So that's just something to watch out for. Items purchased from a charitable organization. An item you purchase from a charitable organization is deductible only to the extent you paid more for an item than its value. For example, you purchased 2 tickets to a charity auction, and the tickets are valued at $100. You pay $150. You can claim a charitable deduction of $50. Membership fee or dues paid to qualified organizations. You can deduct the cost of membership fees that are $75 or less, and you can deduct a larger amount only to the extent that you did not receive additional benefits solely because of those higher dues. If you pay extra to receive extra benefits, you must subtract the value of those extra benefits from your charitable deduction. You can pay more than $75 and receive a deduction for more than $75 as long as you did not receive additional benefits that are not available at the lower membership cost. And I'm going to show you a couple of illustrations here of what I mean, and they're basically based on direct experience. I belonged to the Oregon Zoo for many, many years. When my children were smaller, we were going all the time. And a membership at the zoo was a great deal because a family membership could be purchased for $74, and it gets you in the door every time you want to go to the zoo for free. In fact, you get a special gate that you can go through when there's a line. You just avoid the line. So it's a really terrific deal. Buy a membership every year for $74, deduct it on your tax return as a charitable deduction, and then get through the gate of the zoo for free. But the zoo has higher levels of membership. There's a basic family membership for $74 a year, but it has a higher family membership. You can pay $125 to get a free ticket to go on the train. There's little extra things that they give for people who buy higher levels of membership. including one level here, which is a $500, and it gets you a special sponsorship level where you get your name on a little brochure or listed in the annual publication that the zoo puts out as a special sponsor. And maybe you get to park for $1 a day instead of $2 a day. They have little things like that that they give in exchange for those higher memberships. But they're of nominal value. And what I've seen happen when I get the receipt from the zoo thanking me for that higher level of sponsorship, it says the deduction you're allowed is the full $500. And it's essentially because although these are enticements to buy a higher membership, they really are providing nothing of value beyond what you would get with the normal membership, which is free admission to the zoo. However, there is a written statement that is required if the benefits are greater than $75, and generally the charitable organization you donate to is required to give you a written receipt that breaks down the amount of your contribution from the value of the benefit you receive. Certain exceptions to that rule apply. You can learn more by reading pages 161 through 162 under the heading Written Statement inside Pub 17. Volunteer expenses. You can deduct expenses you paid to provide volunteer services to a qualified organization. To qualify, the expenses you pay must be unreimbursed, directly connected with the services, expenses you had only because of the services, and not be personal or family expenses. For conventions, if you are a chosen representative of the qualified organization, you can deduct your travel and meal expenses directly relating to your official duties for that organization. You may not deduct the cost of personal activities or the cost of bringing family members with you. Uniforms. The cost of uniforms you must wear while performing donated services and which are unsuitable for personal use can be deducted, and examples include choir robes and volunteer firefighting gear. Foster parents, if you care for a child placed with you by a qualified organization, you may be able to deduct expenses that are out of pocket and unreimbursed and used to feed, clothe, and care for the foster child, and also mainly to benefit the qualified organization. Expenses you incur caring for a foster child that you intend to adopt are not deductible as charitable expenses. Now, the thing I have noticed over the years working on tax returns is that at least in the state of Oregon, if you take in a foster child, the state of Oregon gives you a lot of money to care for that child, a substantial amount of money. In fact, I see families that have taken in 3 foster children, and the state is giving them $40,000 a year to care for these foster children. I think it would take a lot of effort to show that the amount that they're spending on these foster children is higher than $40,000. If they could do that, then they could claim that difference as a charitable contribution. But I just wanted to let you know that at least in my state, the amount that the state pays out for these foster children is substantial. So you'd really want to know how much your client is bringing in foster care subsidies for the care of those children and how much they're paying out. And they would really need to show they're paying additional amounts above and beyond what the state is giving them. That said, as foster parents, if they have a child that was legally placed with them by a government agency, that child will still be their dependent. Transportation, you can deduct auto expenses you incur while providing volunteer services to a qualified organization. You must keep written records to prove the expenses. Allowable auto expenses can include the actual cost of gas and oil, but not the cost of repairs, maintenance, or depreciation, or they can claim a standard mileage rate of 14 cents per mile, plus you can deduct the cost of parking and tolls. You cannot deduct the cost of driving to church unless you go to church on official business as a volunteer. For travel, you may be able to deduct travel expenses you incur while providing volunteer services to your qualified organization, subject to the following conditions. Number 1, you must be performing services for the qualified organization, and there can be no significant element of personal pleasure, plus the trip must be substantially for duties you are performing for the organization. If you have only nominal duties or if significant portions of your time are not spent performing those duties, then you may not claim your travel expense as a charitable deduction. Exchange students, you can deduct expenses you paid for students living with you under a written agreement with a qualified organization subject to the following limits and conditions. You may be able to claim a deduction of up to $50 per month per student enrolled in grade 12 or lower. The student cannot be related to you. The student cannot be your dependent. The student must be attending school full-time for 15 or more days in the month claimed, and you cannot deduct the cost of a foreign student living in your home under a mutual agreement where your child goes to live with a foreign family. I can actually say I've got an exchange student right now. He is from Paraguay. He arrived in our household in August. We're not going to get $50 for August, however, because he didn't attend school until September. But we're going to be allowed $50 a month for September through June. I think that adds up to a whopping $450. But it has been fun having him, and I can recommend the program for people who enjoy having young people living with them. And in my case, this young person is going to school with my kids and is part of the family in a real way. Next item we're going to look at is non-cash contributions. These are claimed on Schedule A, line 17. To figure out how much you may deduct for property that you contribute, you must first determine its fair market value at the date of the contribution. You generally can claim a deduction for the lesser of the fair market value of an item you donate or your cost basis in that item. So how do you go about determining fair market value? This seems to be the big question that bothers most clients and a lot of tax preparers. How am I supposed to know what it's worth? Well, it's kind of subjective. So there are some systems you can apply to figure out what the fair market value of an item is. Fair market value, to start, is the price the property would sell for on the open market. It is the price that would be agreed upon between a willing buyer and a willing seller, with neither being required to act and both having reasonable knowledge of the relevant facts. In making and supporting the valuation of property, all of the following factors affect value and should be considered, including the cost or selling price of the item when you first bought it, the sales of comparable properties, replacement costs, and opinions from experts. Now, one of the places I like to go to look for valuations, there's actually two key places. One is I'll go to the Salvation or the Goodwill valuation guides. And the other place I'll go is Amazon or eBay and see what things are selling for there. Some things hold their value really well and have a high resale value, like video games and DVDs and Blu-rays and music CDs. These can have a very high value, and sometimes software does as well. Cameras. My au pair, who had a camera that she wanted to upgrade, she wanted to get a better camera, and the camera she had was a few years old. And so she went on Amazon and determined that she could buy this new camera she was interested in for $1,000, whatever it was, and she was going to be able to receive from Amazon $200 for this camera that she'd had for a number of years. I was astonished how much Amazon was willing to give it to her for. So if that was the trade-in value that Amazon was willing to give her for this camera, if she had decided to turn around and donate that camera to charity, it would have been reasonable to claim a $200 deduction on that camera. So eBay and Amazon can be good places to go. Another place to go would be Craigslist. Some people use the garage sale value. Garage sale values tend to be the lowest of them all. And you're not required to go with the lowest of them all. You're allowed to go with a value that is reasonable, that could be reasonably expected if you sell it in a certain way or a certain place. So there's also a rule, though, for valuation of restricted use property. If you put a restriction on the use of property that you donate, the fair market value must reflect that restriction, and the IRS has published guidelines for assigning values to items in Publication 561. And one such example provided is that if you donated land and restrict its use to agricultural purposes, you must value the land as its value for agricultural purposes, even though it could have a higher value if the use was not restricted to agriculture and could perhaps be used for residential housing, for example. Used clothing and household goods, generally the fair market value of these items is much less than you paid for them. And as a guideline for valuing these items, you should refer to Publication 561 or visit a local resale store. The amount these items sell for at Goodwill or Salvation Army can be used as a good guide. Resale value is often higher than a client might expect, and just as often I have clients that think their stuff is worth far more than it really is. So I've got some clients who feel that 10 bags of clothes when they cleaned out their closets from years and years is worthless. They were just getting rid of junk. They're so happy for it to be gone. They assign no value at all. And then I have other clients who they take down one bag full of things and they think it was worth $400. The truth is somewhere in between there. It's probably worth far more than some people think and far less than other people think. And when my clients come, as often as not, they hand me this donation slip from Salvation or Goodwill that's completely blank. It lacks a description. It lacks valuations. And somehow I'm supposed to read the tea leaves of the universe and figure out what their stuff is going to be worth as a deduction. I thought you'd just figure that out for me, they'll often say. And I'll say, well, in order to even begin helping you figure out what your stuff is worth, I need you to write down a list of what you gave away. Oh, I got all kinds of stuff. I don't know what I gave away anymore. Well, do the best job you can of remembering what it was you gave away and make me a list. So they might sit down there and say, well, I gave away 2 bags of children's toys. Okay, what kind of toys? Was it box games? Did they have all the pieces? Was it, toys where you have all the components? What was the new cost of those toys as best you can recall? We can spend a long time talking about all of these things and making this list as we go. And as they make the list, I say, okay, what do you remember paying for each of these items? Write down what you remember paying for them, because their original cost is going to give me a baseline of what kind of quality the item was, and then I can use that to go through the Salvation Army guide that you see here and come up with some values. And as I said, some things are worth far more than you might expect, and some things are worth far less. Children's clothing is one thing that really surprised me, because there's a really good resale market for children's clothing. You probably have noticed resale shops all over the place that the only thing they do is sell used clothing for children and used children's toys and sometimes used children's furniture, strollers, things like that. And you go into those stores and you'd be really surprised at how much they want for stuff. In fact, my first experience personally in a children's resale store was picking garments off the hanging rack and looking at this little outfit going, gosh, this is cute. And the price on it was $6. And I thought, boy, that's not a lot of money. That's cheap. And I pulled a couple of other things off. Gosh, everything in this store is so cheap. And I got up to the counter and ran it through the register and paid my money. And as I was walking out the store, I realized I was in a resale store. And then I thought, that's expensive for a used thing. So it was all relative. So these items for new prices I thought were very low, but as used items I realized that they were asking quite a bit. And here's some examples of what I saw. A shirt costing $6. Well, as a used value, that's actually quite high. As a new value, it would be considered quite low. But children's clothes do seem to hold their value very well, especially for the little kids, the toddler sizes and the infant sizes, because they grow so fast they're only wearing them for they only wear them once or twice before they're grown out, and they're looking brand new when they're sold. Air conditioners, televisions, microwaves, the resale value on these items. When we go through and look at furniture, furniture often holds its value. And in fact, I am really shocked sometimes at how much complete awful furniture sells for. I remember years ago going into a Salvation Army store and they had this retro. Remember that army green color that they had in the 1960s and 70s? But that was retro, and they wanted big money for it. It was a really expensive set of furniture because it was retro. So don't jump to conclusions on what these items are worth. This is the guide that's provided. And if you can find comparable sales, maybe going into an antique store and getting a dealer to tell you what this stuff is worth, you might get something higher again. So I'm going to let you peruse through all of these valuation suggestions on your own. And we're going to move on to the next topic, which is the donations of cars, boats, and aircraft. Now, I remember the good old days when my clients would come in and they donated a car, and we'd go to Blue Book and see what that car was worth and give them a big fat deduction. Those were the good old days. And as long as the deduction claimed was under $5,000, no valuation was made. But somewhere along the line, the IRS decided, or federal government decided, that too many people were claiming too many big deductions for these donations of cars, and they changed the rules, they rewrote the rules, and all the fun went away. Now we've got some really strict stuff on claiming deductions for donations of cars, boats, and aircraft. And these rules are effective 2006 and later years. And what the rule says is that if you donate a vehicle to charity, your deduction is going to be limited to $500 unless certain tests are met. You will be allowed to claim a larger deduction than $500. You could actually go and use the Blue Book value for the car, but only if the organization that you make the donation to makes significant intervening use of the vehicle, materially improves the vehicle, or transfers the vehicle to a needy individual in direct furtherance of the donee organization's purpose of relieving the poor and distressed or underprivileged who are in need of a means of transportation. So if the charity you donate the vehicle to does not make significant intervening use of the vehicle or donate it in whole to an individual in furtherance of their charitable purpose, then your deduction will be limited to $500 or a higher amount based on what that vehicle sold for at auction. And if you're going to be eligible to claim a higher amount, then the organization needs to issue you a 1098-C. That 1098-C will tell you what the vehicle sold for at auction, and what it sold for at auction will be the amount that you are allowed to deduct. Giving away property that has decreased in value, you can claim a deduction for an item's fair market value only, even if it is less than what you paid. Clothing and household items, we went through and looked at that list of evaluations from Salvation Army. But there's a little bit more restriction on the amount that you can deduct for an item than just what that guide shows. You cannot take a deduction for clothing or household items that you donate unless the clothing or household items are in good, used condition or better. So when you're looking at that Salvation Army guide, you're not allowed to use the numbers on that guide unless the property is in good, used condition or better. Household items include furniture, furnishings, electronics, appliances, linens, and other similar items, but household items do not include food, painting, antiques, and other objects of art, jewelry and gems, or collections. Appraisal for items more than $500. You can take a deduction for a contribution of an item of clothing or a household item that is not in good used condition or better if you deduct more than $500 for it and include a qualified appraisal of it on your return. Donations of inventory. These rules do not apply to donations of inventory. For example, these rules do not apply if you are a car dealer who donates a car and you had been using the car for resale or holding the car for resale for customers. Now, the next item we're looking at is Form 8283. Over the years, when this form is required, has managed to confuse a number of people that I've worked with. They get confused. They think you only need to use the form when you make a contribution to charity of $500 or more. The reality is you need to use the form when the combined total of all non-cash contributions you made to charity and for which you are claiming a deduction exceed $500 for the year. So if your total non-cash contributions for the year are more than $500, you must maintain all records required for donations of $250 or more, plus you must complete and file Form 8283 with your federal return. On Form 8283, you must provide the name and address of the charitable organization, a written description of the items you donated that includes their cost to you and the fair market value on the date that you donated them. Also, you should note that the rule applies whenever total contributions exceed $500, not just when a single item exceeds $500. And here's an illustration of what I mean. You donate used furniture to Habitat for Humanity, and the fair market value of the furniture is $450. 2 months later, you donate books with a fair market value of $50 to the county library, and then you also donate $200 worth of used clothing to Goodwill. Even though no one contribution exceeds $500, all three charities must be separately listed on Form 8283 because the combined total of all non-cash contributions to these charities is greater than $500. In fact, when you add it up, you get $700. So as soon as we go over $500, we need to fill out the form. And on the form, we show in column A the name of the organization and the address of the organization. Then in column C, we enter a description and the condition of that item that was donated. You can see here we've got children's clothes, good used condition, 3 car seats, good used condition, and books in good used condition. Then in the bottom part of the form, and corresponding to each letter we see up here, so a big A up here corresponds to the big A down here, we're going to show the date of the contribution and the date acquired. You are able to enter various as a date acquired, but you can never use various as a date given. For the date given, they always want you to list the actual date given. You then enter the donor's original cost in the item and the best guess you have at its fair market value. And then the deduction is going to be based on the fair market value. And then how did you arrive at the valuation? Well, the instructions for Form 8283 provide 6 different descriptions that you can use. They include appraisal, blue book, thrift shop, resale, comparable sales and auction. And thrift shop or comparable sales are usually the ones that I use. But if you had an auction, for example, it was a car that was sold at auction, that's what you would use. And if you used Blue Book or had an appraisal, it would be appropriate to use those descriptions, of course. So giving property that has increased in value. If you donate property that has increased in value, you must consider the type of property you donated and whether you held the property short-term or long-term before you can determine the amount that you are allowed to deduct. And this is actually one of the areas where people are taking exams, IRS exams or state exams, testing their knowledge of the limits on charitable contributions, that they can get stumped. So this is actually kind of an important part of the course, especially if you are studying for an exam. So if you make a donation of ordinary income property, you can deduct your basis or cost in the property only. And ordinary income property is property that, if sold, would be treated as ordinary income or as short-term capital gain. And examples include you donated inventory or business goods, or the cost you have in an artwork or manuscript, and you are the creator of that artwork or manuscript, or capital assets such as stock or investment property which you owned for 1 year or less. The holding period on those at less than a year makes them short-term, and therefore the income off them is ordinary income. Capital gain property has different rules. Generally, if you donate stock or investment property held for more than 1 year, you can claim the fair market value as a donation, and you can claim that fair market value even if it's more than what you paid. Summary of the Form 8283 rules. All non-cash contributions must be reported on Form 8283, and if the total of all non-cash contributions exceeds $500. You must provide the following information for each organization that you made a non-cash contribution to: the name of the organization, a description of what you donated, the date that the items were donated, and the date that they were acquired, the method used to determine the fair market value of the donated property. Certain donations of household items valued at more than $500 require a written appraisal. For certain donations of items valued at more than $5,000, a qualified appraiser must also provide a written appraisal. The appraiser must sign Part 3 of Form 8283, and the donee organization who receives the gift must also sign Part 4 of Form 8283. You must attach a copy of the appraisal to your return if you donated art valued at more than $20,000, an easement for the exterior of a building in a historic district, or you claim a deduction of $500,000 or more. Let's look now at the limits and carry forward of a deduction. There is no limit on the amount of the deduction you can claim if your total cash or non-cash contributions are 20% or less of your AGI. However, if your contributions are more than 20%, certain restrictions apply, but your deduction can never exceed 50% of your AGI. So this is actually a pretty common question I get from my clients. They'll sit down with me and they'll say, I donated a lot this year. I bet I'm not going to be able to claim it all because, I'm sure that there's a limit on how much I can deduct. How much is it? And I say, well, there's actually no limit on the amount you can donate. You can donate everything you have, but there is a limit on how much you can deduct. And for most people, that deduction is going to be limited to 30% or 50% of their income. So what's interesting is that the limit on charity is based on your income and not on the actual amount you give to charity. So your deduction is going to be limited to 50% of your adjusted gross income if you make your cash or non-cash contributions to a 50% limit organization. And most organizations are 50% limit organizations. Now, even if you contribute to a 50% organization, your deduction will be limited to 30% of your AGI if you contributed capital gain property. And there is a 30% limit as well. Your deduction for cash or non-cash contributions cannot exceed 30% of your AGI if you gave to a qualified organization that was not a 50% limit organization. For example, you donated to a veterans organization, a fraternal society, a nonprofit cemetery. These are examples of 30% organizations. If you gave appreciated capital gain property to a 50% limit organization, then your deduction will be limited to 30% of your AGI. And if you made a cash contribution to a 30% limit organization, your deduction is also limited to 30% of your AGI. And finally, there is a 20% limit. It applies only to donations of capital gain property to a 30% limit organization. So here is a summary of these limits. If you donate cash or non-cash property, The deduction is limited to 50% of the AGI if it's a 50% organization, and it's limited to 30% of AGI for a 30% organization. If you donate capital gain property, then the deduction is limited to 30% of your AGI if you donated the capital gain property to a 50% limit organization, and it's limited to 20% of your AGI if you donated to a 30% limit organization. If you made a contribution to charity that exceeds the limit based on your income, you will have a carry forward. And you will carry forward that deduction to the next year, and you can continue carrying it forward for up to 5 years. So here is a group exercise to just test your retention of what it is I've been asking you. And I'm going to post these questions for you just for a second and let you think about them, and then we're going to look at the answers that I have for these. The first question says, Todd donated $50,000 of cash to help construct a new elephant exhibit at his local zoo, which is a qualified charitable organization. His AGI is $80,000. What amount can Todd deduct? So those of you who are in the audience here, think about this for a minute, and you could chat in the answer. Let's take a look at the rules. Todd donates $50,000 of cash to help construct a new elephant exhibit at his local zoo. His AGI is $80,000. The zoo is a 50% limit organization, and he is donating cash. His contribution deduction is going to be limited to 50% of his AGI. His AGI is $40,000, so his deduction is going to be limited to $40,000. If he donates $50,000, he will have a $40,000 deduction for 2014, and he will carry forward $10,000 to 2015. Let's look at the next one. Richard donated property with an appraised fair market value of $35,000 to his college alumni, which is a 501c8 organization. His AGI is $100,000. What amount can he deduct? I don't specifically tell you that this is capital gain property, but you can assume that it is. So let's think about this. The 501c8 organization is a 30% organization. If you donate capital gain property to a 30% organization, your deduction is going to be limited to 20% of your AGI. If Richard's AGI is $100,000, 20% of $100,000 is $20,000. That means he will deduct $20,000 and he will carry forward $15,000 to his 2015 return. How do I know it's a 30% organization? Because it is a college alumni, a 501c8 organization. So a 501c3 organization would be a 50% organization, and it's these nonprofit cemeteries and these sororities and these societies. Those are examples of 30% organizations. So that one is a tricky one, I know. Now I'm going to give you the trickiest one of all. This one's really going to make your brain work a bit. Jennifer's AGI is $150,000, and during the year she donated land with a fair market value of $80,000 according to a qualified appraisal. Jennifer received the land as an inheritance in 1992 when the land had a value of $30,000. So for tax purposes, her cost basis in the land is $30,000, but it now has a fair market value of $80,000, and she's going to donate that land to her church. In the same year, she also made a $2,000 cash donation to her daughter's school foundation, which is a qualified charitable organization. What is the amount that Jennifer is allowed to deduct? Remember, her AGI is $150,000. What is the amount she's going to be allowed to deduct? So if we flip in the manual to page 57, I've got answers to all three of these group exercises. And let's take a look at number 3 and talk it through a little. And then I've actually gone ahead and filled out some worksheets that we use to compute the allowable deduction. And we'll see how those work. So Jennifer's AGI is $150,000. She made an $80,000 contribution to a 50% organization of capital gain property. So we know that her deduction for that will be limited to 30% of her AGI. She also donated $2,000 of cash to a 50% organization, so that $2,000 of cash should be allowed in full. The church is a 50% organization. We're therefore going to take $150,000 of her income and multiply that by 30%. When we do that, we get $45,000. We're then going to look at the donation of $2,000 to the church, and when we add those two numbers together, we have her deduction, $47,000. So nobody could get the right answer. This one is a tough one. The IRS actually provides a worksheet that you use to actually figure this deduction. So we begin on line 3 in the case of Jennifer, where we enter the cash contributions she made to the qualifying 50% organization, and that was $2,000. On line 4, she enters the total contributions of capital gain property to a 50% organization, and they were $80,000. So the land valued at $80,000 goes on line 4, and the cash at $2,000 goes on line 3. Then on line 9 it says enter your adjusted gross income. Her AGI is $150,000, and then it says multiply line 9 by 0.5 or the 50% limit. That's $75,000. So the maximum deduction she's allowed to claim is $75,000. Is she going to get close to that, or is she going to be limited to something lesser than that? And the answer is yes, she's going to be limited to less than $75,000. Next on line 11, it asks us to enter the amount of cash donated to a 50% organization, and then to subtract that $2,000 from the $75,000 and enter that difference on line 13. On line 14, it says add lines 2 and 3, $2,000 plus $80,000, $82,000. That's what's on line 14. And then it says multiply line 9 by 0.3, that's 30%. So we're going to take line 9, which is the adjusted gross income, and multiply that by 30%. When we do that, we get $45,000. The next step when we go through the worksheet, ultimately it says take line 11 and add line 20 and total those up. When you do that, you get $47,000. That's the deduction that is going to carry to Schedule A. And the difference between $80,000 and $45,000 is $35,000, and $35,000 is going to be the carry forward to 2015. So I'll leave you after class is over to study this form a little bit more, but it's a really good problem where the worksheet helps you sort it all out. When you're donating capital gain property, so the question Jordan has is, I thought it was the lower of basis or fair market value. Lower of basis or fair market value would apply if you are trying to claim the deduction based on a 50% limit. So if Jennifer donated the land and took a deduction based on the 50% limit, she could deduct only $35,000. If she wants to deduct the capital gain value, she's going to apply the $80,000 fair market value, and then she'll apply a 30% limit on $80,000. So she has a choice. She can claim 50% of $35,000 cost, or she can claim 30% of the $80,000 cost and carry forward the difference. It's not hard to decide which would be the better deal for her. She's better off going with that $80,000 contribution limited to 30% of her income. Where you wouldn't be allowed to make a choice like that would be when you're simply figuring the cost basis for capital gain purposes. If she was going to sell the land and report the sale, she would not claim a basis of the fair market value. She'd have to claim a basis of what it was worth when she inherited it. So we were talking about these limits, and then we did our group exercise, and now we're back on page 52 looking at records to keep. You must keep adequate records to prove your deduction, and the IRS has minimum record-keeping requirements for different types of deductions. Firstly, to deduct any charitable donation of money, even just $1, you must have a bank record or a written communication from the charity that shows the name of the charity and the date and the amount of the contribution. A bank record includes canceled checks, bank or credit union statements, or credit card statements. Bank or credit card statements should show the name of the charity and the date and the amount paid. Credit card statements should show the name of the charity and the transaction posting date. And donations of money should include those made by cash or check, electronic funds transfer, credit card, or payroll deduction. For payroll deductions, the taxpayer should retain a pay stub from Form W-2 wage statement or other document furnished by the employer that shows the total amount withheld for charity along with the pledge card showing the name of the charity. Well, some W-2s I'll see box 14 of the W-2 where it might say you weigh $200, and that tells me that that particular employee made a donation to the United Way in the amount of $200, and I can claim it. But there's no requirement that the employer show on the W-2 the amount of payroll deduction that went to charity. So if an employee is saying that they made that contribution and the W-2 doesn't show it, then they would have to show a pay stub. You know, maybe the year-end pay stub will show the total contributions to charity, and you can go with that. Contributions of $250 or more. For any single contribution of $250 or more, you must have a written confirmation from the qualified organization. You must obtain written confirmation by the time you file your return or by the due date, including extensions for your return. Out-of-pocket expenses. If you have deductible volunteer expenses, you must maintain adequate records to prove your expenses. And by the required date, you must obtain written acknowledgement from the organization that confirms you provided the services and what portion of your expenses were not reimbursed. Non-cash contributions, you must keep a written record of each item you donate. The written record should show a description of the property given, the date contributed, the fair market value on the date of the contribution, the cost basis, the amount of the deduction that you are claiming on your return, and you must get and keep a receipt from the organization that shows the name of the organization and all of the information that I've just shown you. But the organization will never show you the fair market value, and they state that they're not allowed to, that it's against the law for them to tell you what they think things are worth. The conflict of interest, I suppose. They would want to max it out to entice you to give more. So ultimately, you're left as a taxpayer applying the rules for valuing the property and claiming that amount. Now, you are not required to always obtain a receipt where it is impractical to get one, but you must still keep a written record, a note or journal of the donation. For example, you make a drop at a Goodwill unattended drop site. There's no one there to give you a receipt. So instead of getting a receipt, you just keep a written record with a description of what you donated, the location that you made that donation at, and how you arrived at the value of what you donated, and the IRS says that is adequate. So it's interesting that under non-cash contributions, you don't have to have a receipt or a record of every donation other than a written record. But with cash contributions, you do have to have verification of some kind for every donation. Now, if you make a non-cash contribution of $250 or more, you must maintain all of the records mentioned for non-cash contributions right here. But in addition, you must also obtain a written acknowledgement that includes a description of the item given and the value of any benefit you received in exchange for the donation. The written acknowledgement must be obtained by the earlier of the date you file the return or the due date of your return, including extensions. Total non-cash deductions that are more than $500. If your total non-cash contributions for the year are more than $500, you must meet all of the record retaining requirements listed in this section and this section up here. And in addition, you must attach Form 80 to 83 to your return. Clothing and household items not in good use condition, you must include with your return a qualified appraisal of any single item of clothing or any household item that is not in good use condition or better, for which you deducted more than $500. The appraisal is required whether the donation is reportable in Section A or Section B of Form 8283. And what about the big ticket items? You've donated something worth more than $5,000. If you donate an item valued at $5,000 or more, you must generally get a written appraisal from a qualified appraiser and then complete page 2 of Form 8283. Generally, you do not need to attach appraisals to your return, but you should keep them with your records. You do not need a written appraisal, however, if the property is non-publicly traded stock valued at $10,000 or less, or a vehicle, including a car, boat, or airplane, if your deduction for the vehicle is limited to the gross proceeds from the sale that would be reported on 1098-C. Intellectual property, certain securities considered to have market quotations that are readily available. Inventory and other property donated by a corporation that are qualified contributions for the care of the ill, the needy, or infants within the meaning of Section 170. Stock in trade, inventory, or property held primarily for sale to customers in the ordinary course of your trade or business. Although a written appraisal is not required for the types of property I just described, you must provide certain information in Part 1 of Section B and have the donee organization complete and sign Part 4. Art valued at $20,000 or more. If your total deduction for art is $20,000 or more, you must attach a complete copy of the signed appraisal. And for individual objects valued at $20,000 or more, you must also include a photograph upon request. The photograph must be of sufficient size and quality, preferably 8 by 10 inch color photo or a color transparency no smaller than 4 by 5 inches that fully shows the object. Easements in a building in a historic district. If you claim a deduction for a qualified conservation contribution of an easement on the exterior of a building in a registered historic district, you must include a signed copy of a qualified appraisal, photographs, and certain other information with your return. Deduction of more than $500,000. If you claim a deduction of more than $500,000 for an item or a group of similar items donated to one or more donees, you must attach a signed copy of a qualified appraisal of the property to your return unless an exception applies. You should refer to Form 8283 for instructions for exceptions. And then finally, Part 3 of Form 8283. If you are required to get an appraisal, you must get it from a qualified appraiser, and the appraiser must complete Part 3 of Form 8283. A qualified appraiser is an individual who meets all of the following requirements. The individual has either earned an appraisal designation from a recognized professional appraiser organization for demonstrated competency in valuing the type of property being appraised, or they must meet certain minimum education and experience requirements. The individual regularly prepares appraisals for which he or she is paid. The individual demonstrates verifiable education and experience in valuing the type of property being appraised. And to do this, the appraiser can make a declaration that because of his or her background, experience, education, and membership in professional organizations, he or she is qualified to make appraisals of the type of property being valued. The declaration must be part of the appraisal. However, if the appraisal was already completed without this declaration, the declaration can be made separately and associated with the appraisal. And finally, the individual has not been prohibited from practicing before the IRS. And if you go back and think about the ethics education classes I've taught, or if you take a look at Circular 230, there are segments in there that refer to qualified appraisers. And you cannot rely on an appraisal from an appraiser who has been disbarred for practice before the IRS. If you use appraisals by more than one appraiser, or if two or more appraisers contribute to a single appraisal, then all appraisers must sign the appraisal in Part 3 of Form 8283. Information here on where to claim your deductions, but let's move on to non-deductible contributions, and then we'll wrap up this class. And I see it's right at the top of the hour, so those of you who are in a hurry to leave are going to want to do so. So I'm going to put up the final password of the day. Password number 3 is Josie Wales, JOSEYWALES. So let's take a look at the types of things your clients may want to deduct but can't. So firstly, we have contributions to individual. If you see the beggar on the street and you give him a buck, it's non-deductible. Contributions to individuals not allowed. Contributions to non-qualified organizations. You cannot deduct a contribution given to an organization that is not qualified to receive tax-deductible contributions. And examples of non-qualified organizations include homeowners associations, labor unions, civic leagues, chambers of commerce, and political organizations or candidates. Contributions from which you benefit. You cannot claim a deduction for contributions you make to a qualified organization to the extent that you receive benefits in return. Examples of non-deductible benefits include child care, raffle tickets, tuition, contributions directed towards lobbying for legislation, etc. Value of time or services. You may not claim a deduction for the value of your time or your lost income. Logically, this is because you've never included your time in your income and paid tax on it. Cost of meals. Unless your volunteer duties require you to be away from home overnight, you cannot claim a deduction for the cost of meals. Adoption expenses. Costs associated with adopting a child are not deductible. However, you may be able to claim an adoption credit instead. So that concludes today's class. The only thing left is a look at classwork assignment number 2, and it's a super simple one. Involves preparation of Schedule A and Form 8283 for a character named Angela Biggins, who is single. Her AGI is $30,000 for the year. Her 1098 mortgage statement shows she paid $5,000 of mortgage interest. Property taxes were $1,000. She had $3,000 of state withholding on her W-2. And during the year, she gave the following items to charity. She gave away a 1991 Honda Civic with 200,000 miles on it. It sold at auction for $1,000, and her cost basis in the car was $2,000. She also gave $500 to church, and she is involved in volunteer search and rescue, for which she has trained search and rescue dogs. The cost of caring for those search and rescue dogs was $1,000 for the year, and she also drove 1,000 miles for her volunteer duties of search and rescue. So let's go ahead and prepare her Form 8283, but before we do, I wanted you to see her 1098C for this auction of that Honda Civic. And you can see that the gross proceeds from the auction are $1,000, and we're going to use this information to prepare her return. And here is the answer key for that. And I'm going to quickly fly over to per 8283. And on the 8283, we're going to show the name and address of the charitable organization. We check the box indicating that a 1098-C is attached to the return. And then we indicate the mileage and a description of the car. Then down below we show the donated, the date bought, the purchase price, and the fair market value, and the fact that the valuation came from auction. Back up on Schedule A, we're showing all of the deductions associated with the information I gave you: income taxes paid to the state, real estate taxes on her home, mortgage interest on her home. She has the volunteer search and rescue expenses, plus she has the non-cash deduction. And to show where we came up with the cash deduction, we're going to be taking the donations that she made to charity and treating the contribution for the search and rescue as a cash contribution. So she made a $500 donation to church. She spent $1,000 caring for those search and rescue dogs. That's $1,500, and then she's going to get 14 cents per mile. So when we add all of that up, we get the deduction that we've entered on Schedule A for her, which is this $1,640 of cash contribution, and then the non-cash contribution goes on line 17. So her total itemized deductions are $11,640. So that concludes today's class on taxes, interest, and charitable contributions. Thanks for participating. I hope to see you again soon. Those of you who are self-paced students, not live webcast students, the manual does have some assignments at the back of it, and you do need to complete those assignments for course credit. But those assignments apply only to the students who are taking these courses as self-paced courses. So again, thank you for participating in today's class. I hope to see you again soon, and bye-bye. We hope you've enjoyed this tax education class. Pacific Northwest Tax School is approved as a CE provider by the IRS and the states of Oregon, New York, and Texas. We have been awarded the Quality Assurance Standard by NASBA and meet the CE requirements for CPAs in most U.S. states and territories. Tax clients demand knowledge and experience. Pacific Northwest Tax School provides the in-depth, practical education needed to improve your understanding of tax law and to meet the demands of the competitive tax preparation industry.